I'm Al Brooks, and thank you for watching the Brooks Trading Course. This is the first of two videos on how to trade. In this video, I'm going to be talking about what markets can do. And when you look at a chart, it's often easy to come to the conclusion that the market has a very high probability of doing something. Whenever you have that feeling, you should pay particular attention to the market doing the exact opposite, because whenever something seems like it has a very high probability, the probability is not nearly as high as you think. Take a look at this chart. The low of this bar is above the low of that bar. And for 16 bars, the market did that. It's a bull microchannel, no pullbacks. Chances are, bulls have been buying at or above the low of the prior bar, and now they finally get a chance to buy the low of the prior bar. Chances are they'll buy it. Yet the market's telling you they're not buying it. Chances are means high probability there are buyers below. Yet, once you start to see 2, 3, 4 bear bars closing on their lows and the body's getting bigger, the market is telling you it doesn't matter what you thought was likely. If you keep denying that the market can go down and you keep buying, you're going to lose money. Price is truth. If the market's going down, you have to sell. It doesn't matter if it doesn't make sense. If it's going down, you have to sell. And as long as the trader is in denial that the market is doing something, he's going to be experiencing a lot of pain, and it's called a pain trade. So whenever a low probability event starts to unfold, you cannot remain in denial. You have to look at the chart and say, hey, I know it's supposed to go up, but it's not going up, it's going down. And when that happens, no matter how unlikely something appears to be, you have to look at the chart and believe the chart. The price is truth, not your instinct. You have to trade what you see, not what you expect to see or hope to see. So 16-bar bull microchannel, yet a bear reversal. And by the time you get the third consecutive bear close on the low, especially with the bigger bear body, you have to be thinking, it's going down. You got to sell. So you sell the close. That's a reasonable way to approach that. And then here we have a very tight bear channel. It's a bear microchannel to this point, 7 consecutive bars without a pullback. Then we have a little pullback here and then down another bar. So it's a very tight bear channel, also a very strong channel. Chances are the first bull breakout will be a bear flag and will continue down. That's what the probability is. That is true. But that is not an absolute guarantee. If the market starts to have 2, 3, 4, 5 consecutive bull bars, you have to say, this is one of those times when there are not sellers above. It's going up. So at some point, you have to decide that the probability is wrong. It's the low probability event is taking place. So you got to buy. Maybe the 4th or 5th close, you just buy the close and don't question that the market should not be doing what it's doing. It's doing it. You got to do what the market tells you it's doing. Price is truth, not what you believe probabilities are. Here, a very strong outside down bar, yet the next bar is a bull inside bar. So the market's going up. Doesn't matter if this is a big bear bar, the market's going up. You got to buy. And here we have a pair of very strong bull bars breaking above the top of this trading range. So theoretically, it's going up. Chances are this is a measuring gap, not an exhaustion gap. Yet, once you start to see 1, 2, 3 bear bars, 4 bear bars, bodies getting bigger, closing on their lows, it doesn't matter what the probability is. It's going down. You have to sell. When I look at every chart, I classify each piece of price action into breakouts, tight channels, broad channels, and trading ranges. So if the market's going up and it's going up strongly, no pullbacks, big bars closing on their highs. Here it's only one big bar closing on its high, but it's about a 10 or 15 bar bull microchannel. Very strong momentum. And when I see that, I'm going to buy. How am I going to buy? I'm going to buy for any reason. I'll buy it at the market when it's going up. I'll buy a bull close. I'll buy above the high of the prior bar. I'll place a stop order to buy above that bar. I'll buy a bear close, betting that the first attempt to reverse down will fail and that will continue higher. Look at this. We have a breakout here and then we have a pullback and another pullback and another pullback. So once a breakout begins to have pullbacks, it's then in a channel phase. And if the channel is very tight like this, it's basically a breakout. It is a breakout on a slightly higher time frame chart. If this is a 5-minute chart and you look at the 15-minute chart, the 15-minute chart will look like this. and you're only going to be buying on the 15-minute chart, well, 5-minute chart, not much different from a 15-minute chart. You should only buy. And you can buy for any reason. You can buy below bars betting bear reversals will fail. You can buy above bars betting that the trend resumption will succeed. You can buy bear closes. You can buy bull closes. Tight bull channel, treat it like a breakout, only look to buy. Over time, even tight bull channels begin to get deeper pullbacks. And sometimes the pullbacks are so strong, like here or here, the market becomes always in short. Yet, still higher highs, still higher lows. So it's still a bull trend. Because there are deep pullbacks, bears can start making money. They can sell above prior highs and make money. Sell above this high, make money. They can even sell reversals down many times and make money. So this is basically a trading range that's sloped upward. And because it's a bull trend, you should buy. However, because the pullbacks are deep, you can also sell if you want to sell. In general, if you're selling in a broad channel, unless the reversals down are very big, most traders only scalp on the sells. On the buys, they can swing or scalp. So traders tend to scalp more, swing less. They buy pullbacks, 50% maybe. The midpoint of the last leg up, around a 50% pullback, trying to resume. You can buy that, stop below here. But you can also sell. You can sell a reversal down. You can sell at a prior high. And you can use limit orders, and you can scale in more. So you can buy for any reason. You can buy the reversal up here, buy more lower. You can buy at that low, buy more lower, buy on the reversal up. In a trading range, it's very similar to a broad channel that is perfectly horizontal. You want to buy low, sell high, and scalp. You can buy as the market reverses up using a stop. You can buy at a prior low using a limit order. Traders will also sell, but they want to sell high in the top third of the range. They can sell at a prior high, use a wide stop, scale in higher. They can sell on a reversal down, especially a second entry short, a micro double top. Both bulls and bears believe one thing, that the market's not going to go very far up or down, and therefore they scalp. They buy and they sell somewhere in the middle. They sell at the top and they buy back their shorts somewhere in the middle. Buy low, sell high, scalp. Traders are only interested in value. They're looking to buy low, it's cheap. They're looking to sell high, it's expensive. Unlike in a breakout, when traders are trading momentum. You have momentum traders during breakouts, buying high, expecting it to go higher. And in trading ranges, traders are value traders. They want to buy low, not buy high. They want to sell high and not low. Now here are the corresponding bear charts. No pullbacks, a lot of bear bars closing below their midpoints or on their lows, so strong bear momentum. And when that's the case, no matter where you sell, it does not matter because you're confident that the market's going lower. High probability of lower prices, so you can sell at the market. You can sell a bear close, you can sell below a bear bar. And then next, you have a pretty strong bear trend, but then a pullback and other pullbacks along the way. We have a breakout here. You have another breakout here. You can say the channel began with this pullback. You can say we have a breakout, another channel beginning with this pullback. Doesn't matter. On a higher time frame chart, this looks like this. So this is basically a breakout. And because it's a breakout, traders should only look to sell. And again, sell for any reason. You sell above a bar betting the bull reversal will fail. You sell below a bar betting that the reversal attempt has ended and the market's going to resume down. You can take partial profits at new lows if you like. But you should be thinking about swinging most of your position. And then finally, we have a channel, lower lows, lower highs, but the reversals up can be pretty strong. In this particular case, the chart never really became always in long, but there were still pretty good reversals up. I would still call it a broad bear channel. It's a bear trend, so I definitely want to sell. Any pullback that goes somewhere in the middle of the prior leg down, I want to sell. So leg down, somewhere in the middle, I want to sell. But you can also make money buying. So you can buy at the prior low, scale in lower. Also, the bears, when they do sell, they'll tend to scalp more. So at every new low, they buy back their shorts, and that creates another pullback. A bull buying here, he might buy more lower, and when it gets back to his first price, he gets out break even on his first entry and a profit on his second entry. And then I talked about trading ranges. So in a bear trend, every bear trend is made of some combination of these four things: a breakout, a tight channel, a broad channel, or a trading range. In the bear trend on your chart, maybe you have 100 bars on the screen in front of you. It can be simply this the whole time, very unlikely. It could be this the whole time, very unlikely. It could be this or that the whole time, much more likely, because broader channels and trading ranges are more common than strong breakouts. A strong breakout like this occurs maybe 5 to 10% of the bars on the chart. So it's a brief opportunity to get a very high probability trade. But the trade-off for the high probability is risk. If you're selling here, your stop is up here, so your risk is greater. Yet, you're doing that to get high probability. Now, you already know that life is not fair. And I'm using this slide to illustrate an important point. When traders start out, they're always asking me, Al, what's your secret setup? I'll be really nice to you, and if you just tell me, one secret setup that I can use to make a lot of money, and I promise I won't try to make too much money, but I do want to make enough to have a decent life. I want to feel like a successful trader. And they believe that Goldman Sachs or any hedge fund has these secret setups. And they don't exist. And if you look at a lot of websites, you'll see all these candlestick patterns that look like they're extremely profitable. It doesn't exist. You're trading against the smartest people in the world, and they're very competent. So any advantage that you have is always going to be small. It's a quixotic quest looking for a windmill. Looking for a perfect trade, it's just not realistic. And traders sometimes get frustrated. A lot of times I'll be talking about the market, and I'll be talking about how the bears can make money and how the bulls can get money. And traders say, well, Al, you just don't know what you're doing. Take a position. But only during 10% of the bars on the chart is one side clearly having a big advantage. During 90% of the bars on the chart, if you know how to manage your trade, you can make money buying, and you can also make money selling. I can make money buying here if I buy more here and then get out up here. I can make money selling here if I scale in here and get out down here. This would be probably more of a break-even trade. But if you manage your trades correctly, most of the time, 90% of the bars on the chart, you can make money buying or selling. Just because you're working really hard does not mean you deserve to make money. Even if you're a nice person and polite and respectful, does not mean you deserve to make money. You can be a really rotten person and make a lot of money. It has nothing to do with your personal qualities. It simply has to do with your ability to structure and manage trades. And it's just unfortunate that so many websites make it sound like trading is easy. Just read my website and follow these 10 rules and you're going to make money. You're not. Trading is a lot of work, and that's why this course has so many videos. Because if you really want to get good, you have to put a lot of time in. And the more you know, the better you're prepared to make money. So you'll look on the internet and say, oh, here's a bull reversal bar. And they call it a hammer in the candlestick book. It's a buy. No, it's not a buy. It's occurring in a 9 or 10 bar bear microchannel. Chances are there are sellers above that bar, not buyers. You need to look at context, and the context is terrible for the bulls. The market's going down. I don't care if there's a bull bar there. Here we got a bullish piercing line. Who cares? Right? The channel down is very tight. The reversal up is probably minor. Next, we have a bearish hanging man pattern. Do I want to be selling here? No, it's the bottom of a 20-bar trading range. I don't want to do that. And then here we have an outside up bar, a bullish engulfing line. Do I want to be buying here? We got a bad follow through on the way up. Bull bar, bear bar, bull bar, bear bar. We're stalling here, micro double top. We're at a lower high. We have a very big bear bar here. Do I really want to be buying at the top of a trading range? No, trading range, you buy low, you don't buy high. So candlestick patterns are not enough. Here, we got a bearish engulfing line. So is that a good sell? The channel up is too tight and there just are not enough bear bars in it. It's a low probability sell. Chances are you're selling in the bottom of a trading range. Learning a handful of candlestick patterns and expecting to make money, that's delusional. It's not going to happen. And those websites that make it sound easy, if you see any website that talks about trading is easy and making money is easy, you know the person is wrong. They're wrong. Leave the website no matter how appealing the website appears to be, and no matter what promises they're making on the website. The key to making money is learning how to structure a trade. Where do I get in? Where's my stop? How do I get out of the trade? Do I scale in? How much do I risk? What's my profit goal? All right? How likely is it that my trade is going to be profitable? Okay? There's no one way to trade. There's no perfect way to trade. The goal of the videos is to show you many ways to structure trades that make mathematical sense. If you look at this chart, you say, well, wait, I don't see anything there that looks all that good. That's what a normal chart looks like. It's filled with a bunch of stuff that doesn't look good. The probability is never as good as you want. Yet, if you look at the volume of this bar, the volume of this bar, the volume of even this bar, there's big volume on all of those bars. How can that possibly be if none of the bars looks like it's a great setup? It's because traders understand what they're doing and they're structuring trades and they can enter on any bar. It doesn't matter if I buy here or anywhere in between. If I think the market's going up, I'm going to buy. If I think it's going down, it doesn't matter if I take the first sell. If I miss the first sell, if I take a second or third sell, if I take a fifth or 10th sell, it doesn't matter. It's still going down. It's going to go lower. So it doesn't matter if I miss the first sell. I can sell on any of these bars. And that's one of the points I make throughout this course, that there are countless ways to enter. The key is not your entry. The key is structuring your trade. Where is your stop? Where are you going to get out? What are you going to do if the market goes against you? That's what you have to do to make money. And you can enter on any bar. On an E-mini chart, for example, a typical day, 81 bars, there are probably decent scalp setups on half of the bars. The scalps for a 1-point profit. And if you're looking at a 15-minute chart or a 60-minute Forex chart, where the average bar is more than 10 pips tall, and you're looking at a screen with 100 bars on it, there are probably 15 or 20 trades where you can make 10 pips or more. But you have to know what you're looking for, and you have to know how to structure the trade and manage the trade. I talked before how we have a strong breakout here, and only 10% of the bars on any chart are in a strong breakout. In a strong breakout, the probability is high that the market's going to continue in that direction. When the market's doing this, I only want to sell. All right? If it's breaking strongly to the upside, I only want to buy. The other 90% of the bars, I could structure a trade to buy profitably or sell profitably. Here, a very strong bear breakout. Climactic, a little bit bigger bar. Can you buy that sell climax and make money betting on a bounce? Well, you can. We've got a bear bar here, bad follow through, bear bar here, bad follow through here. In fact, you can make money buying at the end of this buy climax, betting that it will soon transition into a channel or a trading range. But you only make money buying here if you're using a wide stop, maybe a measured move down based upon the height of that entire leg to that point, and if you're willing to buy more lower. For example, buy below the big bull bar, betting that the market's transitioning into a trading range. In a trading range, most breakouts fail. We're getting a break below that bull bar, it's probably going to fail. And then you expect the market to transition into a trading range. You buy here, you buy more here, and then you get out here. And look what happened when it got back to that price, or near the high of that bull reversal bar. It sold off. Why did it sell off? Because a lot of bulls were selling. The bulls who bought either above that bull bar or that bear close and bought more lower are selling out, taking profits. Break even on their first entry, profit on their second. And guess what? The bears know the bulls will do that, so the bears will place limit orders to sell there, and that creates that brief sell down. Now, I said you can make money buying that close. Well, it's also a very strong bear trend, so you can sell that close as well, betting that you'll get a channel and you'll be able to make a profit on the way down. The market looks like it's trying to go sideways, tails, sideways bars, big bars. They bought below the low of this bar. They bought below the low of this bar. They'll probably buy the low of that bar as well. So you sell here, you buy back here, take your profits down here, and you can make money selling. The traders who consistently make money, they're structuring their trades well. You can structure a trade at any point on any chart. Your plan has to make sense, and you have to manage your trade well. For example, bear trend, pretty good bull breakout, and then a higher low, 2 legs down. So it's a higher low, major trend reversal. A pair of bear bars here, maybe you don't want to take the first entry. However, the second entry, higher probability. And also we have a double bottom attempt here. We got a bear breakout and we're reversing up. We're reversing up again for a second time. To me, it's a reasonable buy, around a 50% pullback, a little bit higher. So it's a higher low, major trend reversal, also a failed breakout below a double bottom, and it's a second entry, first entry, second entry. There's the double bottom. So you buy here, maybe you put your stop here, maybe you put your stop down there. So is this a pretty good top? Should you get out down here? Well, you could. You could argue 3 pushes up, failed breakout, but it's a pretty tight bull channel, so it's probably a minor reversal. You can continue to hold and just take your chances that it's going to drift higher. The rules are not that complicated. When I trade, my first rule is don't lose money. Don't do anything stupid. My second rule, I make money. And my third and least important rule is I make a lot of money. And sometimes the third rule happens, but I really concentrate on the first two. I try not to lose money, and I try to make money. Here, 2 time frames. Daily chart, 5-minute chart. You can sometimes reduce risk by entering on the 5-minute chart, even if you see a setup on the daily chart. Bear trend, a pullback, resumption, and now we're coming back to the top of that pullback. The bears want a double top bear flag and a reversal down. And a certain number of traders will take that short. Now, when I'm trading a 5-minute chart like this, I don't look too much at the daily chart because there are very few signals on the daily chart. And the 5-minute chart has lots of signals all day long. But sometimes when I see something like this on a daily chart, I'll look at the 5-minute chart to see if there's an entry. A lot of traders, they see this and they don't want to risk all the way up here. A lot of times they'll try to enter on a smaller time frame chart, hoping that they'll reduce their risk and increase their reward. When you do it, you slightly reduce your probability as well. For example, here you have a bear trend. You look at resistance, the top of the pullback, and then let's say you're a trader who likes trading the daily chart, and you look to sell near resistance, looking for a double top bear flag. Instead of selling below the bottom of yesterday's low, you might put up a 5-minute chart and enter on the 5-minute chart. Bear trend, 50% pullback. This line is this line right here. This is the 5-minute chart. Pretty strong rally, but a micro double top, up, down, up, a sell possibly below that bar, and it will give you an earlier entry than what you would get on the daily chart. Is it much of a reduction in probability? I don't know, probably not much, right? Higher probability to sell below the low of the prior bar on the daily chart, but here you can do it on the 5-minute chart. And you're greatly increasing your reward, and you're also greatly reducing your risk. So your risk is only up here, from here to here, whereas if you sold on the daily chart, your risk, you'd be selling below the low of the prior bar, so probably somewhere down here, and your risk would be all the way up there. Pretty good reversal down. You can sell with a limit order at the 50% pullback. So bear trend, 50% pullback, possible double top, the top of the sell climax. So you can sell with a limit order right at that 50% pullback, or you can say, pretty good bear bar, a pair of bear bars. Probably this reversal up will fail and form a double top. So you could place a limit order to sell above the high of that weak bull flag, above that bear bar, or even above the bull bar. Or you can enter on a stop and sell the second reversal down. Here's the first reversal down, here's the second reversal down. In any case, if you're a trader trading the daily chart and you're trying to reduce your risk, a lot of times you can look at the 5-minute chart and get an earlier entry with smaller risk and still pretty good probability. And if you turn it into a day trade, we're getting near the end of the session, we could take partial profits at 1 times your initial risk. So let's say you sold here, your initial risk is to above the top of that bar, and this is about the same distance, so it's 1 time your initial risk, and you can take partial profits there and then hold the rest into the close if you want. Here's a 5-minute chart and a 1-minute chart. Most traders who are using 2 time frames, you're finding the setup on the higher time frame chart, and then you're entering on the lower time frame chart. Most of the traders who do this are looking at day session charts. their higher time frame chart would be maybe a 60-minute chart, and then they would look for an entry on the 5-minute chart. But you can also do it looking for setups on the 5-minute chart and then entering on the 1-minute chart. But I really think most traders should be totally ignoring the 1-minute chart because it's just too easy to make mistakes. If you're a very proficient scalper or consistently profitable scalper, sometimes you will put up a 1-minute chart and look for an early entry. But as I said, most traders should not do that. Most traders should never look at a 1-minute chart, because even though when you print it out at the end of the day, it looks pretty easy, real time, you just don't have enough time to make decisions and you'll make too many mistakes. Here, we got a bear sell-off, so a spike and then a channel. And leg 1 is this size, and leg 2 started here. So at some point when it's going down, you decide this is the start of leg 2. So you look for a measured move target. So leg 1, somewhere in here, you're thinking, oh, maybe it's a leg 1, leg 2 measured move. So you draw a line, and then you look for the market reaching that target. You can also look and call it a wedge, 1, 2, 3. And on the 1-minute chart, this is the bottom of that wedge, and it's also at that leg 1 equals leg 2 measured move. If you're looking on the 5-minute chart, you might want to buy above the high of that 5-minute bar. But if you're very confident, and you should be pretty confident, the market fell below this low and reverse up. You're getting a stairs pattern. The pullback is overlapping the breakout point. Chances are falling below this low, it's going to reverse up at least above that low. The traders are pretty confident, and an aggressive trader who, as I said, is consistently profitable will sometimes look at the 1-minute chart and get an earlier entry. A little bit more reward. Here's the 5-minute chart. There's the entry. On the 1-minute chart, that same entry would be right around there. If you were taking the trade on the 5-minute chart, you would get in here. If you pull up a 1-minute chart, you'd discover that you entered right there. But because of the context being so good, you could put up a 1-minute chart and take a 1-minute entry above the high of that bar. If this was an E-mini chart, you'd be buying maybe 5 ticks lower by buying here. And your risk would be lower, maybe down here. If it was a Forex chart, maybe you'd be buying 5 pips lower. So your risk would be lower, and because there's more left to the trade, your reward would be higher. Probability is always a little bit less on a 1-minute chart compared to a 5-minute chart, but not all that much less. Where do you take profits? Well, you get 3 pushes up, a wedge, 1, 2, 3, maybe a double top here, possible double top here. On the 5-minute chart, this is over here, reasonable place to take profits on the reversal down from the wedge. 5-minute chart, 1-minute chart, a bear chart, a strong bear breakout. You only want to be entering in the direction of the trend. I'm using an example of a 5-minute chart. You're looking for setups on the 5-minute chart, and then some traders will put up a 1-minute chart to get an earlier entry. But you can also look for setups on the 60-minute chart and then use the 5-minute chart for the earlier entry. Again, most traders should not be trading a 1-minute chart, but really skilled traders sometimes do that. Selling off pretty strongly, so you can sell closes, sell that close, sell that close, sell that close. And if you're looking at a 1-minute chart, if you pop up a 1-minute chart, sometimes you can get an earlier entry. The market's selling off here. Here's the 1-minute chart selling off. And instead of waiting for the close of the 5-minute bar, and you start to see 3, 4, 5 consecutive bear bars closing on their lows on the 1-minute chart, you can sell the close on the 1-minute chart. Also, even though there are no pullbacks here, on the 1-minute chart there are pullbacks. So you can sell at the high of the prior bar, betting that the reversal attempt will fail, become a bear flag, and be followed by lower prices. And the same here. So you can sell with limit orders above bars, betting that these bull reversal attempts will fail. And you don't even have these signals on the 5-minute chart, because there are no pullbacks on the 5-minute chart. If you're in a microchannel on the 5-minute chart, you can put up a 1-minute chart and then sell bull breakouts, betting that the bull breakouts will fail and that the bear trend will resume. You can also sell below bars. Bear trend, a pullback, it's a bear flag, sell with a stop below the low of the prior bar. Again, you don't see any of this in the 5-minute chart because there are no pullbacks. So there are setups that you can see on the 1-minute chart. If you believe the 5-minute chart is strongly bearish and you can sell for any reason, well then you can put up a 1-minute chart and sell for any reason as well. And sometimes there are patterns that you can see on the 1-minute chart that are not present on the 5-minute chart. In this video, I talked about some of the things that the market can do. And basically, the market is in a strong breakout, maybe 5 to 10% of the bars on the chart. And then it's in channels, 90% of the bars on the chart, channels or trading ranges. Channels can be tight, and if they're tight, you only trade in the direction of the trend. If they're fairly broad, you can trade in both directions. And then eventually a channel transitions into a trading range, and when the market's in a trading range, you buy low, sell high, and scalp. No matter how certain you are that the market's going to do something, you should always assume that it can do the opposite, because there's always an institution taking the opposite side of your trade, and you really need to be respectful of your opponent because he is just as smart as you are and he has good reasons for doing what he's doing. So if you only see one possibility, that means you're in a position to get trapped into a very painful situation, a pain trade. Always assume that the more certain something looks, the less certain it really is, because there are no perfect trades. And price is truth. It doesn't matter what you believe. If the market is doing the exact opposite of what you believe, change your belief and trade what you see, not what you hope will happen. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 2 videos on how to trade. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 2 videos on how to trade. In this video, I talk about the market cycle. Every chart and every part of every chart is either in a breakout, a channel, or a trading range. And it's important to learn to recognize what the chart is currently doing, because you trade differently depending upon what part of the market cycle the market is currently in. Next, I'm talking a little bit about the trader's equation and the 40-60 rule. 10% of the time, 10% of the bars on any chart are in a strong breakout, and traders should only trade in the direction of the trend. But 90% of the bars are either in a channel or a trading range, and when that's the case, there's a 40 to 60% chance that the market will go up, 40 to 60% chance the market will go down, and if you structure your trades correctly and manage your trades correctly, you can make money buying or selling during 90% of the bars on the chart. Finally, I'm going to be talking about default targets. In case you cannot decide when you should get out of a trade, it's always good to have a rule. And I'll talk about some simple rules that traders can use to determine an appropriate mathematical time to exit a trade. The market cycle. The market is in a never-ending cycle. It keeps recycling the same patterns over again. And it's important to learn to recognize where you are in the cycle, because you trade differently depending on what the market is doing. For example, we have a bear channel and then a reasonably good bull breakout. A bull breakout, you trade it one way. You only want to be buying when it's in a strong bull breakout. However, when it's in a channel, you always want to be buying, but sometimes if the channel is broad enough, you can sell as well. And then after a channel, it usually evolves into a trading range. If the legs in the trading range are reasonably broad, you can buy low, sell high, and scalp. If the range is too tight like this, it's better to not trade at all. A big fallacy about trading is that there are really important times to enter, and those are the only times a trader should enter. But if you look at the volume on any bar, on any chart, on any time frame, there's good volume all the time. And that tells you that institutions feel like any time is a good time to trade. And that is absolutely true. And if you learn how to read charts, you can structure trades pretty much on any bar at any time. As long as you structure the trade so that you have a positive trader's equation, the probability of winning times the reward is greater than the probability of losing times the potential loss. That is an acceptable trade. Although you can enter at any time in the market cycle, during a breakout, during a channel, during a trading range, some traders prefer certain types of setups. Some traders prefer breakouts. Some traders like channels. Other traders like trading ranges. It doesn't matter. If you're comfortable trading all 3, trade all 3. I think it's often helpful to try to structure binary decisions. Binary decision means give yourself two choices. Is it a bull trend or a bear trend? Is it a bull leg and a trading range, or is it a bull leg and a bull trend? If it's a bull trend, is it a breakout or a channel? And you trade it differently if it's a breakout or a channel. Bull breakout, you need to get long and you need to buy at least a small position, and you buy for any reason. And in a channel, a lot of times traders prefer to buy pullbacks. So you get a pullback to around the middle of the last bull leg, you buy on the reversal up. A bull leg, a pullback, buy on the reversal up. Bull flag, buy the breakout. When a channel is reasonably tight like this, when it's a bull channel, it's usually better only to buy. By tight, I mean the pullbacks are only 1, 2, or 3 bars. They don't drop down very far. It's much easier to make money as a bull than as a bear in a tight channel. And whenever the market's in either a breakout or a channel, especially a tight channel, it's good if you can swing at least part of your trade. Can you sell in a bull channel? Well, I would only sell in a bull channel if it's reasonably broad and if there's enough room for scalps. Because you don't want to be selling at this high and then have the market go up and never drop back below this high. This is a fairly tight channel and it's difficult to make money. Even selling this high, you sell here, try to buy for a scalp. When the channel is tight and the pullbacks only last 1 bar or so, it's harder to make money. In general, if you are selling in a channel, the first time you sell, it'll be limit orders. So you sell at the high of the prior bar, maybe scale in higher. And it's better only to do it if the market's in a stair pattern, where the market breaks to a new high and then pulls back below the breakout point. Breaks above this high, pulls back below the breakout point. So you sell the high and you hope to make a scalp. Again, this channel is so tight, very difficult to make a scalp because the pullbacks are very small. In general, a tight channel like this, it's a breakout on a higher time frame chart. It's usually better only to look to buy. A skilled limit order trader can sometimes make money in a tight channel like this, but again, unless the pullbacks are more than just a bar or two, it's usually better only to buy. However, a good limit order trader can avoid a loss if he manages his trade well. Even selling at the high of this bar, so you sell here, you can see it never pulled back to that price, so you're going to lose money on that trade. But if you scale in higher, maybe below this bear bar, you might be able to get out at the midpoint of your 2 entries and avoid a loss. Again, that's only for skilled traders. You sell here at that high, and then you sell more below a bear bar on the reversal down. And then you try to exit at the midpoint between your 2 entries, and you avoid a loss. You lose on this trade, you win on this trade, and the loss is exactly equal to the win. Very often, a trading range begins when the market is still in a bull channel, and it's not clear yet that the trading range has begun. Here we got a bull breakout above a bear trend, and we got a pullback. Traders will buy the reversal up. So you take the buy signals, and you can take strong sell signals, especially second entry shorts. So you buy here, you buy a pullback here. Really not good shorts here. The channel's too tight, the pullbacks are too small. But up here, you get a wedge, 1, 2, 3, a bear bar. You can sell below that bear bar, or maybe below here for a second entry short. But you're not going to make much money. You're looking to scalp. You have a bull channel, which is a bull trend, and you're hoping it's converting into a trading range. And in a trading range, you're not looking for a major reversal. You're looking for a minor reversal, a brief leg down, enough for a scalp. Wedge bull flag, a good opportunity, good reason to exit your short. So you sell here, and you either get out at a fixed number of ticks or pips down, or on a reversal up here from a wedge bull flag. And then when it gets very quiet like this, very tight, it's better not to trade. You stop trading. When the market's going down, also use binary decisions. Is it a bear trend or is it a bear leg in a trading range? Now, very often a bearish channel spends a lot of time in a trading range. And if it is, then traders can trade in both directions, especially if the legs are big. Here, they're not all that big, so difficult to make money buying. Clearly a bear breakout, a big bear breakout, closed below the low of the past 20 bars, far below the low. Chances are there'll be at least a small second leg down, possibly a spike, pullback, and channel down. So when you see a strong breakout like this, you have to get short for any reason. You can sell at the market, you can sell above bars, you can sell below bars, but you need to sell at least a small position, either at the market or on a pullback. We have trend resumption down here, another bear bar closing on its low. You can sell that. We're trying to reverse up here. Pretty tight bear channel, strong bear breakout, probably at least a measured move down. So you should bet the bull reversal will fail. So you sell above bars. And then here you got follow through bars. You can sell closes. Here you got a double top, this bull bar, that bull bar. You can sell the reversal down. Here you got a small double top. You sell the reversal down. You can go to triangle. We went up and then down, up, and you sell the reversal down. If the stop is far, for example, if you sell here, the stop is pretty far. You have to trade small. And if you cannot trade small enough, do not take the trade. You only trade if you can manage it correctly, and an important part of managing correctly is using an appropriate stop. Spike, pullback, and then it looks like we're channeling down here. Different ways to draw channels. Channels tend to become flatter as they mature. In general, when the channel is pretty tight, and this one is pretty tight, it's better only to sell. So you can sell maybe a 50% pullback of the last bear leg. Here's a pullback, here's another bear leg, so sell somewhere in the middle of that bear leg or on a resumption down. And can bulls buy? They can see if a trader bought that low, it went up a little bit, maybe not enough for a scalp, but because it went back above the breakout point and did not form a gap, traders will buy the breakout below this low. So they'll place a limit order at this low, get filled here, and then try to make a scalp up there. A bear channel, especially a tight bear channel, it's a trend, so it's better to swing at least part of your short positions. And again, you short for any reason. You short bear closes, you short attempts to reverse up, you sell below bars as the trend is resuming down. There are many opportunities to sell all through here. You're obviously not going to take any of them, but the point I'm making is you can enter on almost any bar. If you know what the market is trying to do and you're flat, you need to get short, and there are many ways to do it. Can you buy in a bear channel? Well, only if the bounces up are big enough for at least a scalp. If they're not, if the channel is pretty tight like this, usually better only to sell. It's a bear channel, so it's a bear trend. It's easier to make money selling. However, traders can buy, but there are several things you have to have in your favor to do that. First of all, you need pullbacks to go above breakout points. This pullback went above that breakout point. Next, you want the pullbacks to go up high enough so that there's room for a scalp. And finally, it's better to only do it if you're a very experienced and consistently profitable trader, because it's too difficult to make money buying in a bear trend. Now, I said you need overlap. You need a stairs pattern. You need pullbacks to go above breakout points. If you are buying in a bear channel, the very first buy you should take should only be a limit order buy, buying at the low of the prior low or buying below that low. Again, you should only do it if you're an expert. You place a limit order to buy at this low, you get filled here. You place a limit order to buy at this low, you get filled there. Once the swings up start becoming big, then traders could start entering with stop orders. But until you have reasonably big rallies, it's better only to enter with limit orders. And again, only a really skilled trader should do that, and he should only do it if the pullbacks are big. And this is barely big enough to do that profitably. And finally, you have to do it using the appropriate stop and trading the appropriate size. So if you do buy, let's say you buy here, it doesn't go up, you buy more here on the reversal up. There's a small bull bar here. And then you try to get out, break even on the first trade right here, and with a small profit, a scalp on the second trade. Whenever a trader is disappointed by what the market is doing, it's usually better either to try to get out break even or with only a small profit. If the swings are big enough, you can also enter with stop orders above bull bars on the reversal up, but that's not the case here. These swings, the rallies are too small to be entering with stop orders because you do not want to be buying too high up when the rally is not going to go much further. Trading range, this is a trading range. It's also a bear channel, and very often a bear channel is also in a trading range. If it's not clearly in a trading range, it's better only to be trading in the direction of the trend. Here, we're clearly in a bear trend. We're in a trading range here as well, but very tight. A tight trading range in a bear trend, you certainly do not want to be buying yet. You're better only to take the sell signals. For the bears, it's a double top bear flag. Here's the neckline. They want to break out and a measured move down. Weak rally. If you do buy here, you have to be pretty quick to get out. You cannot expect a big move up. It's a minor reversal. It's a wedge, but a very tight channel. Probably a minor reversal in a trading range. And that means you're looking for a scalp. Maybe on a reversal back down, you take your profits right here, especially 3 pushes up, 1, 2, 3. So it's a wedge bear flag. It's a double top bear flag. You gotta get out. And bears know that as well. They know that the bulls will give up. So what they do is they sell at the same price. When the range becomes extremely tight like this, it's better to just stop trading. You're not going to be making money when it's this tight. Bull channels, we're in a bull channel here. And then you can call it a breakout or you can call it a very tight bull channel. This is a broader bull channel, and the legs down are big enough for the bears to make money. And maybe even it became always in short here or here. Some traders would think so. And so you have to assume it's a broad bull channel. Here we have a breakout, not particularly strong, and then a pullback. So this is actually a very tight bull channel. A tight bull channel is a breakout on a higher time frame, and a broad bull channel is basically a trading range that's sloped upward. In general, a broad bull channel, you get a rally and a pullback to around the midpoint. You want to be buying somewhere in the middle third of the last leg up. Another rally, buy somewhere in the middle third. Another rally, buy somewhere in the middle third or the bottom 2/3. Another rally, you want the pullback to go at least 1/3 down. So you want to buy, somewhere in the middle third, bottom third. That's the buy zone, the bottom 2/3, the bottom half of the most recent leg up. And those are the ideal locations to buy. A rally and then a pullback. You try to buy somewhere in there. Rally, a pullback. Try to buy here. You can also buy, at the market, you can buy bear closes, betting that they'll fail to result in a bear trend. Or the easiest way is simply to buy a reversal up, especially above a bull bar. Bulls will also buy strong bear closes because it's a bull trend. The bulls will bet that the bear reversal attempts will fail. It's a great thing to do. Bull trend, around a 50% pullback. Bears trying to get a breakout. It's a bull trend. The bear breakouts will probably fail. Why not buy them, betting that they'll fail? Because the probability is on your side. After each strong breakout to new high, then you have a major high or low. Traders raise their stops. So new high up here, traders will raise their stops. Tight bull channel, you trade it like a breakout because it is a breakout on a higher time frame chart. You only want to buy. You do not want to sell. And you can buy for any reason. You can buy the third or fourth consecutive bull bar. You can buy below a bar, betting the reversal attempt will close. You can buy a breakout above a small bar, pull back, breakout above a bull flag. Doesn't matter. You got to buy for any reason. Here's a bear channel, and parts of it look reasonably strong. Maybe some computers will see it as always in long. Whenever you have a bear channel, and at times it looks like it might also be always in long, yet it continues to form lower highs and lower lows. It's a fairly broad bear channel. However, something like this, very tight. So when the market's doing this, better only to sell. But for the rest of it, you can buy or sell. The sell zone, somewhere in the top 2/3, top half of the prior leg down. Bear breakout, a pullback to the middle third, top 2/3, that's the sell zone. Bear breakout, pullback somewhere to the middle of that. it's the sell zone. Bear breakout, the top 2/3, you want to be selling somewhere in there. Bear breakout, top 2/3 of that breakout, you want to be selling in here. Okay, bear breakout, the top 2/3 of that bear breakout, so you're looking to sell somewhere in here. Those are the sell zones. Bears are looking to sell pullbacks into the sell zone, and they'll also sell a reversal back down. So you can sell with a stop as it reverses down. Now, bears believe it's a bear trend, and they're correct. So they believe any attempt by the bulls to reverse it up will fail. And therefore, bears will sell bull bars, strong bull closes, right? Strong bull close, strong bull close, strong bull close. The bears will bet that these strong rallies will fail to get above the top of the last major lower high. In other words, they'll bet that the bear trend will resume and the bull reversal will fail. So they look for a strong bull buy and then they sell it. Stop above the top of the most recent major lower high. Bear breakout, new low, reasonably strong bear breakout. If you sell at any point after this bear breakout, your stop is up here. It's a bear trend, so it's easier to make money selling, and traders should be concentrating on selling. And because it's a bear trend, you can sell either for a swing or for a scalp. You can see every new low, there's a bounce up. That tells you that bears are taking partial or full profits at new lows, and then they're selling rallies, expecting another new low. Experienced traders can also buy reversals up. We've had pretty good buying pressure here, pretty good buying pressure here, pretty good rally here as well. So traders will buy at the prior low or on a reversal up from the prior low. In general, if you're buying in a bear trend, a bear channel, it's better only to scalp. So you buy here and you get out somewhere up in the sell zone where the bears will start to short. Look at this chart. Starts in the upper left, goes to the lower right. It's a bear channel. We got lower highs, lower lows. But if you only look at this part of the chart, 90% of the chart, it's also in our trading range. As the trend gets late, as it progresses, it tends to weaken and it eventually evolves into a trading range. And when it's in a trading range, even though it's still arguably a broad bear channel, when it's in a trading range, traders look to buy low, sell high, and scalp. So we have a bear breakout. You can call it a bear channel. It evolved into a trading range. It's also a broad bear channel. And traders are looking to buy reversals up from new lows, look to sell near the top of the range, either with limit orders or, better yet, on a reversal down. If a leg up is pretty strong, don't take the first sell. Look to take the second. Don't take the first. Look to take the second. Don't take the first. Look to take the second. Whenever things are unclear, always wait for a second entry or for more clarity. And trading range, you want to be selling in the upper third and then buying in the lower third. And because it's a trading range, you do not believe it's going to go up very far. You do not believe it's going to go down very far, and therefore you scalp. Here's the upper third of the trading range, and traders will look to sell in the upper third, and they know that the probability is 60%, maybe higher, that the market will go down 10 ticks or 10 pips before it goes up 10 ticks or 10 pips. Does not matter what number, X number of ticks up or down, X number of pips up or down. If you're selling in the upper third of a trading range, the odds are it'll go down before it goes up the same number of ticks or pips. So the math is good for the bears. Upper third of the range, look to sell a reversal down, sell a reversal down, sell down. And the bottom third of the range, the opposite is true. Traders look to buy because they know that the probability is 60% or greater that the market is going to go up before it goes down. Up how much? Any amount. Up 10 ticks, 10 pips, 20 ticks, 20 pips before it goes down the same amount. And if you're uncertain about a reversal, wait for a second entry. Everyone knows that the market cycle means that the market alternates between trends and trading ranges. If the market's in a trend, it'll become a trading range. If it's in a trading range, it'll become a trend, and the trend could be down or the trend could be up. So traders trade it like a trading range as long as it's in a trading range, and once it clearly converts into a breakout, then they switch and begin to trade it like a new cycle. Every cycle begins with a breakout, so you go from a breakout to a channel and a trading range. I said this is also a broad bear channel. Broad bear channels are mostly trading ranges. During a lot of the time when the market's in a broad bear channel, it's also in a trading range. And that's why if the market is in a broad bear channel, a lot of traders will trade in both directions. Some computers will look at this and say, it's lower highs, lower lows, it's a bear trend, a bear channel. Other computers will look at it and say it's mostly sideways, it's a trading range. And they trade them the same. They look to sell in the upper third, they look to buy in the lower third, and then they scalp. It does not matter what you call it, because you're going to be trading it the same. You're going to be buying low, selling high, and scalping. BLSHS. When you look at it this way, you can see it looks more like a broad bear channel. Lower highs, lower lows, but it's still also a trading range. What happens if you miss the best signal? Well, the reality is there is no best signal and there is no perfect trade. But there are lots of good signals and you can enter on almost any bar. I made that point earlier. And that's a big fallacy that traders don't understand. Strong bull breakout, you only want to buy. But once it starts to form a trading range, you can enter on any bar and make money if you manage your trade correctly and use an appropriate stop. So you can buy here or sell here and make money. You can buy here or sell here and make money. If you sell here, how do you make money? Well, you sell more on a rally, and then when it gets back there, you get out break even on your first entry and a profit on your second entry. You can enter on almost any bar. Strong bull breakout, you only want to buy. You can buy closes, you can buy below bars, betting the reversal will fail. You can buy above bars, betting the trend will resume up. Pretty tight bear channel, you can sell above bars, betting the reversal up will fail. Double top bear flag, slightly lower high, and triangle, second entry short, you can sell with a stop on the way down. In general, if you think it might be in a trading range, it's better to be looking to buy low and then sell rallies and scalping. It doesn't matter where you begin trading in the market cycle. You can trade in the bull trend phase. You can buy for any reason at any time, all the way up. And then once you start to pull back, you have to assume you're either going to be forming a bull channel or a trading range. And it doesn't matter because you trade them very similarly. You want to buy low, sell high, and scalp. Every bar on every chart of every major market has big volume. And that tells you that traders, institutions are buying and other institutions are selling all day long. And the difference, one of the differences between a beginner and an experienced trader is an experienced trader sees a reason to buy and a reason to sell on 90% of the bars on the chart. Like this, you only want to buy. But like this, a good trader is going to see a way to sell and a way to buy, and then he just tries to structure a trade that can be profitable, either buying or selling. You have to understand where you are in the market cycle, and you have to trade appropriately, trade the appropriate size, and it's easier to make money as an experienced trader if you're also able to scale in. I want to talk now about the trader's equation and the 40-60 rule. It's a rule that I came up with. I have several rules like that. Now, look at this chart. Very strong breakout. Now, how many bars on this chart are in a very strong breakout? Maybe 100 bars on the chart. Here we got 4 or 5 bars in a strong breakout. In general, on any chart, only 5 to 10% of the bars are in a strong breakout. And when they are, you only want to be trading with the trend. 90% of the bars in the chart are either in a trading range or a channel. And that is when my 40-60 rule applies. Bulls and bears can make money taking opposite sides, and it doesn't matter which side you take. So anywhere through here, if you structure your trade correctly and manage it well, you can make money buying or selling here or here or here or here. Same with here. And it doesn't matter whether you buy or sell. And it doesn't matter which bar you choose for your entry. 90% of the bars on any chart you can buy or sell and make money if you manage your trade well. Here we have a bear trend, a very strong breakout and a higher low. You can call it a head and shoulders bottom if you want. Doesn't matter. It's a higher low major trend reversal. It's a pullback from a very strong bull breakout, around a 50% pullback. The earliest entry is buying with a stop above the high of the prior bar. The risk is small, either to this low, which is the best stop, maybe to below the low of the signal bar. Small risk, big reward, great risk reward. That always comes with low probability. Whenever you have a great risk reward for your trade, you know the probability of making money is small. If you wait to buy during the breakout, you stop as much further away, the risk is greater, and there's less profit left. The reward is less. So the risk reward is worse buying during the breakout phase, but the probability of making money is much higher. And that always is the case. Whenever you have a high probability trade, the risk reward is bad. Whenever you have a low probability trade, the risk reward is good. Both are acceptable, again, if you manage them correctly. So let's say you buy this high or low major trend reversal. It's a weak buy signal bar, a doji, instead of a bull bar, and it's following a pretty strong bear bar, so the probability is low. In general, whenever you're taking a low probability trade, you need to get a reward equal to at least 2 times your actual risk. So let's say you buy above the high of this bar. Your actual risk was just below the low of that bar. Let's use your initial risk. You can call it actual risk. It's about the same. So you buy here on this bar. Stop is here. This is 1 times your risk. That's 2 times your risk. And if you hold for a reward that is equal to 2 times your risk, even in a low probability trade, a 40% trade, the math is good for making money. So it is an appropriate thing to do. A very strong breakout like this, do you really want to take your profits here? You can, the math is okay, but the minimum profit is usually not the optimum profit. When you see a strong reversal like this, yes, you can get out at 2 times your risk, but chances are the market's going to go higher. If you can, try to hold for a bigger profit. Let's say instead of taking the low risk, low probability trade, you wait for the strong bull breakout and you buy that close. You know the probability is high that the market's going higher, but your risk is big. However, whenever you have a high probability trade, you no longer have to hold for a reward that is twice as big as your risk. In fact, as long as you go for a reward equal to at least your risk, it's a profitable strategy. So if you buy here, stop down here, one default target would be 1 times your risk. Your actual risk is tiny. If you buy here, your actual risk was small. It's just below the low of this bar. High probability, you could go for 1 times your actual risk, but that is not a good thing. Usually the minimum is not the best. When you see a strong breakout like this, I would look for some kind of a measured move based upon the height of this bull bar, so somewhere up here. The trader's equation says that as long as you go for a reward at least equal to 1 times your actual risk, the math makes sense. It's a good trade. So you buy this close, your actual risk was to just below the low of this bar, so 1 times the actual risk is right here. Theoretically, you could take your profit right here, and mathematically that would be a profitable approach to trading. But it's not a really good approach to trading because you'll probably get a measured move based upon the height of this bar. There's a 60% probability that you'll get a measured move based upon the height of this bar, so why exit right here? The minimum is rarely the best, right? To graduate from college, maybe you need a D average. Are you going to be happy getting a D average? Are you going to be happy working for the minimum wage, right? It's an acceptable wage, it's a legal wage, but the minimum of anything is rarely the best. When you see a breakout like this, high probability of at least a measured move up, so probably a 60% chance that the market is going to go up for some kind of a measured move, maybe based upon the initial risk. Maybe you put a stop here, or you put a stop here, or a measured move based upon the size of this body, from the open of this bar to the close of that bar. So this is 1 times approximate initial risk if you put the stop below the bottom of that breakout bar. Buying after a strong breakout, high probability, but you pay for it with big risk. The stop is far away. Here's a pretty good bear trend, very tight channel here. Let's say you sell the close here after 6 consecutive bear bars, all 6 closing below their midpoints. It's a high probability bet the market's going lower, not necessarily all the way here, but at least somewhat lower. You know that all trends are constantly trying to reverse, but you also know that markets have inertia and they tend to continue what they've been doing. So if the market's in a trend, chances are reversal attempts will fail and the trend will resume. Every one of these reversals is minor, and it can be hard to hold short. You sell here and you see the market constantly trying to reverse, but you should hold short. And if you're not short, you can sell above every reversal bar, betting that the reversal will fail. Bet that it will be minor. A minor reversal, you got a tight bear channel trying to reverse. A minor reversal means that it's either going to be a bull leg in a trading range or a bull leg in what turns out to be a bear flag. You have to learn to rely on your stop. And if you sell here or anywhere here, your stop is up here. In general, when you have a reasonably strong trend, it's better if you can swing. Most traders should only swing. Experienced traders will often scalp and take a profit, scalp and take a profit, scalp and take a profit. But a lot of traders, especially beginners, will not get back in and they'll end up missing the trade. So don't scalp when you should swing. The math is good for scalping, but the problem is you do not sell again and you end up missing 80% of the trend. You only scalp in a strong trend if you're able to sell again. Now I'm going to talk a little bit about default targets. When you cannot decide where to get out, there are some basic rules that I use. Let's say you sold right here, your stop is above there. That's your initial risk, the height of that red rectangle. And there are lots of ways to take profits, and none of them is perfect, but it's good to have a default plan, a basic plan that you use whenever you're not sure what to do. And you can change the targets based upon support and resistance or the momentum that the market has. Most traders are not particularly good about determining probability. As I said, 90% of the bars on the chart, the probability is between 40 and 60% that you'll make a profitable trade, or that the market will continue or go the direction that you expect it to go before it hits your stop. Let's say you sell here, your initial risk is there. If you cannot decide where you should take profits, a good default is always 2 times your initial risk. There's your initial risk, here's 1 times, here's 2 times. So that's a reasonable location to take profits. So on any trade, if you cannot decide where you should be taking profits, it's always good to take at least partial profits at 2 times your initial risk. And I say always because let's say you're taking a trade that turns out to be a low probability trade, and you were not sure that it was low probability when you entered the trade. Low probability is 40%. The trader's equation math is always good if you're going for a reward equal to 2 times actual risk. Initial risk is always greater than actual risk. If your default plan is to go for a profit that is 2 times initial risk, the math is always going to be good. Here's 3 times initial risk. So a reasonable approach is to take half off at 2 times your initial risk, and then take another half off or 25% more off at 3 times initial risk. And then let's say you take a quarter off here, and then you just swing the balance and you rely on your protector stop. After every strong breakout to a new low, you have a new major lower high. So you lower your stop to just above that new lower high. Toward the end of the session, you look for any reason to exit. For example, a new low, reversal up here. Pretty good bull trend. We have an attempt at a double bottom. We got a bear breakout and then a pretty good reversal up. And pretty strong sell-off, pretty strong reversal up. So lower low, major trend reversal. Bear trend, bull breakout, lower low. So you can buy a reversal up above here, above here. You can buy a strong bull close there. Lower low, major trend reversal. Higher low, major trend reversal. Maybe not major, not all that many bars, but it's a reasonable buy. I think the market went always in long on this reversal up. Strong breakout, 3 consecutive bull bars closing near their highs. Over here, right here. 1, 2, 3. So you can buy closes. And let's say you buy this close. Your stop is going to be below the most recent major higher low, and that's this. Major because it went to a new high, and it's a strong leg up. If you buy here, your stop is here. And what's your default whenever you're not sure what to do? Well, in general, 2 times your risk. 2 times your actual risk, but a lot of traders will go 2 times your initial risk. You buy here, stop down here, 2 times your risk is up there. Let's say instead you bought here. Your initial risk is below the low of this bar? Let's look at that. If you buy here, this is 1 times your risk. So you buy here, your risk is here. This is 1 times, so that's 2 times. And you can see that traders who did buy here, a lot of them did exit at 2 times the initial risk because we got a pullback at that price. You could also exit on a reversal down, arguing it's a type of a wedge, 1, 2, 3, 4, or 1, 2, 3. In any case, it's the top of a bull channel. Traders will either take profits with a limit order at 2 times their initial risk or on a reversal down below a bear bar. Can you sell this? Well, you got a bear bar, but it has a tail below, and this channel is pretty tight. Even though it's a wedge or a type of a wedge, it's a minor reversal, and probably the best you get is a trading range. And the trading range could have a couple legs down, or it could simply be sideways, as it was here. Another wedge, 1, 2, 3, but again, a very tight channel. You could take profits there if you want, but I would not be selling there because the pullbacks are too small and the channel is too tight. The market's still always in long, even with this reversal. So traders will buy a reversal up. They'll buy a reversal up. They'll buy a reversal up. Still always in long, so traders will still buy reversals up. There are entries all during the day. On any time frame, there are entries all on every bar. There's big volume on every bar, so you can enter at any time. And one of the purposes of this course is to teach you ways to enter. You don't have to wait for perfect setups. You're never going to find them. It's okay to wait until the market is clearly always in long or clearly always in short, and then trade in the direction of the trend. So a strong bull breakout after a lower low, major trend reversal, pretty strong reversal. So the market's always in long. It's probably going higher. So you can buy for any reason. For example, you can buy that close. 3 consecutive bull bars. The bars are getting bigger, closing on its high, closing with a high of maybe 20 bars or so. And look what followed. We have a series of additional trend bars, and now we have 7 bars up without a pullback. So a 7-bar bull microchannel. That's a strong bull trend. We're probably going higher even if we pull back. Again, you can buy closes. This is a buy the close bull trend. You can buy that close because the market's clearly always in long. And even if there is a pullback, the odds are high. Bulls will buy it and will go higher. Whenever you buy, it doesn't matter if you buy here or here or here, your initial stop is down here. You could put it here once you see this breakout. If you do have it here, your stop is further away. I think you could put it here if you bought here or here. You have to trade small. If your stop is far away, you always have to trade small. Now, some traders, they'll buy and they'll scalp and buy again and scalp and buy again. Some traders will buy and take partial profits, and then at another signal, another buy the close bar, they'll put their full position back on. Trend resuming up, buy the close, buy the close, buy the close, or buy above any of these bars, buy below any of these bars, arguing that this is strong enough so that there should be at least a small leg up. Strong breakout to a new high, and therefore this is a major higher low. At this point, traders will raise their stop to below this low. After each new major higher low, you raise the stop. So the bottom of each new strong leg up, raise the stop, because at that point, this higher low becomes a major higher low. And if it's a bull trend, it should not pull back below the low of that major higher low. If it does, your premise of a bull trend is wrong. The market at that point would then either be in a bear trend or simply in a trading range. Another breakout, 6 or 7 bars up. This is not clearly a major higher low, but a lot of traders after 6 or 7 bars up will trail their stop to below that low. Stronger breakout, pair of good bull bars, new high. So another major higher low. Traders will raise their stop again. In this video, I talked about the market cycle and the things that it can do. Every chart can either be in a trend or a trading range. If it's in a trend, it can be a breakout. You only want to trade in the direction of the trend. Or it can be in a channel. If the channel is tight, only trade in the direction of the trend. If the channel is broad, It's good to trade in the direction of the trend, but you can also make money scalping in the opposite direction. And then eventually the channel evolves into a trading range, and there traders should look to buy low, sell high, and scalp. I talked about the trader's equation and how you only want to take a trade if you can structure a trade with a positive trader's equation. You want the probability of profit times the size of the profit to be significantly greater than the probability of loss times the size of the loss. I also talked some about the 40-60 rule. 10% of the bars in the chart are in a strong breakout. You only trade in the direction of the trend. 90% of the bars in the chart are either in a broader channel or in a trading range, in which case the probability of making money is between 40 and 60%. So let's say your stop is 10 units, 10 pips, 10 ticks below. If you go for a reward that is twice that, you have a positive trader's equation because the probability is at least 40%, and anytime you hold for a reward equal to twice your risk, you're going to have a positive trader's equation. This is Al Brooks. Thank you for watching the Brooks Trading course. This video is the second of 2 videos on how to trade. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 4 videos on trading major trend reversal tops. An important thing about tops is that you need strong bears to make a reversal. I'm also going to talk about the minimum targets that you should be considering. When traders are looking for a higher high major trend reversal, they need some evidence that the bears are reasonably strong. Here we have a bull trend and a potential higher high major trend reversal. Look at this. We have a rally lasting a couple of legs, the third leg. Chances are, once the market's always in long, the first reversal down will be minor, which means it'll become either a bull flag or a trading range, not a bear trend. And now we have another strong leg up, and therefore any reversal down again will probably be minor. But look at this reversal. It went sideways for about 15 bars or so, and it broke below the bottom of the bull channel. And we have a decent bear bar here and a decent bear bar here, 2 legs down. The bulls lost control of the market for a lot of bars, and the bears were strong enough to break below the moving average and stop the bulls for about 15 or 20 bars. When that's the case, that is enough selling pressure so that traders will suspect that the next reversal attempt, instead of being minor, leading to a bull flag, it might be major and last 20 or more bars and go down for a swing. In addition, not only did the bears stop the bulls for 20 bars, they were strong enough to put a couple of bars completely below the moving average. There's a gap between the high of this bar and the moving average, a gap between the high of this bar and the moving average. If the market's in a bull trend and now the bears are getting strong enough to put bars completely below the moving average, then the bears are reasonably strong. So yes, minor reversal and bull flag and bull trend resumption, but after gap bars, the market usually tries to form a major reversal, and therefore traders will look to sell a reversal down from testing the bull trend high. Here's the top of the bull trend. We're breaking above it and the breakout's failing. Traders will sell below here, betting that there's a 40% chance for a major reversal. A reversal down where the reward is at least twice the risk and usually lasting 20 or more bars. Traders need the minor reversal to be strong if they're going to start looking for a major reversal. And it doesn't have to lead to a big reversal down. It can simply be the bears stopping the bulls for 10 or 20 bars, as they did here. That is enough strength on the part of the bears for traders to think that the next reversal attempt might be major and not just minor. We have a double bottom bull flag. Every double bottom is a high 2. So a bull trend, bull breakout, pullback, resumption, a double bottom, slightly lower low. And when you get a double bottom bull flag, a high 2 bull flag, 20 or more bars into a bull trend, late in a bull trend, you have to be thinking that the next leg up might be the final leg, and that the high 2 bull flag might become the final bull flag. The final leg here, we have a bull bar, not especially big, bad follow through. Another good bull bar, bad follow through. We have a third bull bar, bad follow through. So even though it's a bull micro channel, no pullbacks lasting about 8 bars, the rally is not as strong as you might think when you see a bull micro channel. Whenever you get a bull bar and bad follow through, and you get several like that, the leg up is probably a bull leg in what will become a trading range and possibly a major trend reversal. We have a double top. I said we have a double bottom. We also have a double top. The market tried to reverse here. Instead, we broke out. And this rally with that bear bar might be a failed breakout above the double top. Anytime you have a double top and then a breakout that starts to reverse, it's a type of a wedge. You have 3 pushes up, 1 pullback 2 for the double top, pullback 3. It's 3 attempts to go higher. Even though it does not look like a wedge at all, it's the same forces that operate with a wedge, and therefore you can expect the same kind of reversal that you can expect with a wedge. There is a wedge, in fact, here as well. Rallied, sold off, and now we're at the top of a channel. Again, if I drew a trend line along the bottom, it wouldn't look very much like a wedge, but it's 3 pushes up and we're getting a reversal down from the top of the channel. And there's also a parabolic wedge here as well. Bull bar, pause, bull bar, pause, bull bar, reversal. So this is a wedge and it's within a larger wedge, and then we have a breakout above a double top that looks like it's reversing, and that is a type of wedge as well. So smaller wedge patterns inside of a larger wedge pattern, that means nested wedges, that has a higher probability of leading to a reversal. You can also draw a wedge from the low. We have a leg up, pull back, second leg up, pull back, and a third leg up. Again, it does not look like a wedge, but it's 3 pushes up. Some computers will look at this as the wedge. Other computers will say the wedge is here, even though this low is below this low. In other words, the first high of the wedge came before the end of the bear trend. It's still a wedge. Markets often transition from bear trends into bull trends, and during the transition, they have components of both. So yes, we're still in a bear trend here, but some traders would say the bull trend began here before the bear trend ended. At least that's how I would look at this. Some computers would also look at this as a wedge, a rally, a pullback, even though it's a pullback below the bull breakout, and then a second leg up, and then a pullback, and then a third leg up. And as I said, there's also a parabolic wedge. Many ways to draw a wedge, all reversing at the same point. Nested wedges increase the probability that you'll get at least a couple legs sideways to down. We have a negative gap. We have a high here, and we pull back below it. We pull back below it a little bit as well. Some overlap of this trading range with this trading range. However, the overlap is not especially great, and therefore this can lead to a measured move up. Whenever you get a pullback below a breakout point, I view that as a negative gap. So instead of an actual gap, I call it a negative gap. Here's an actual gap, this low, that high, no overlap. There's a gap here between this low and the buy signal bar high. That is a gap. Here we have overlap between the breakout point and the pullbacks, negative gap, but it still often leads to a measured move. And therefore, I'm always drawing lines to see how the market behaves near that resistance. And you can see the market's trying to reverse. This is a good-looking sell signal bar, a bear bar closing on its low. That further increases the probability that the bears will get at least a minor reversal. Selling here, you probably have about a 40% chance of a swing down. It's a fairly strong bull trend here. We have about an 8-bar, 9-bar bull micro channel, and we do not have a micro double top. However, if you want higher probability, you wait for maybe 3 or 4 consecutive bear bars. At this point, we have a higher probability of at least a small second leg down. It's reasonable to take this short. The risk is to just above the high of the bar. You might use a wider stop in case there's one more small leg up, but the risk is small compared to the potential reward. Even though the probability of a swing down is only 40%, the reward is sufficiently big to offset the lower probability. the market's clearly still always in long at this point. And that is why the probability is only 40% that the reversal will be successful. If you wait for 3 or 4 consecutive bear bars or a pair of decent bear bars closing on their lows, and then sell either that close or above these bars, looking for at least a small second leg down, the probability can be 60% or more that you'll get some kind of a swing down. At this point, the market probably is always in short, meaning that the bears have taken control and we're probably going at least a little bit lower. If you short here, your stop is further away, your risk is greater, your reward is less because you're entering after the bear trend has already begun, but the probability of making money has gone up. And that's the trade-off. Whenever you enter when the trade has higher probability, your risk reward is always worse. You never get high probability with good risk reward. You get one or the other, but never both. There has to be a reason for an institution to take the other side of the trade. Anytime you take a trade, you have to have a plan on how to take profits. I always operate with the idea of a minimum profit. What's the smallest profit that I need to have a positive trader's equation? What's the smallest profit that I can go for so that the math makes sense and I should take the trade? We're getting late in the day. Traders will look for reasons to take profits, especially since the rally is not particularly strong. On any trade, the minimum target is always 2 times the actual risk. If you sold below the low of this bar, you entered on this bar, you actually only had to risk to above the high of this bar, so you risked very little. Mathematically, it's always reasonable to take profits at 2 times your actual risk. However, if 2 times your actual risk is smaller than the minimum scalp, that does not make sense. Also, the minimum reward is rarely the best reward. The minimum is just the minimum needed to make the trader's equation positive. Like anything in life, going for a minimum is not always the best choice. And if you're taking profits consistently at the minimum level, that is not a good thing. When the actual risk is very small like this, it's better to be looking at the initial risk. If you sold below the low of this bar, your initial stop is above its high, and that generates your initial risk. That's your initial risk. And taking a reward, at least partial profits at 2 times your initial risk, makes sense mathematically. That's better than 2 times actual risk when the actual risk is tiny like it is here. Also, you're taking profits around a 50% pullback. The bull trend might resume. And you're also taking profits at the moving average. So it's reasonable here to take profits at 2 times the initial risk. You're also at the bottom of the final buy climax bar, and the market often pauses or even resumes up at that point. We have a bear spike, a bear breakout, second push, third push, and now we're getting a second reversal up, first reversal up, second reversal up, and we're getting near this low, the bottom of the final bull leg. We might be entering a trading range. We're also getting late in the day. It's reasonable to take profits here as well. The final possibility is holding until the end of the session. Here we have a double top bear flag, and we may get a collapse into the close. We probably will not. It looks like this was resistance. We turned down, and then it became support. We're probably in a support level, and we probably will not break strongly down, but it's reasonable to hold short until the close, just in case we do. Theoretically, if a bull got out above this high or that high, and he's trading always in, he always wants to stay in the market. He has to sell again below a reasonably strong bear bar, which is below this bar. The market's still always in short. It did not become always in long here. So if he's trading always in, he has to sell again here, and then he would get out at the end of the session. Whenever there's a third push up, traders have to be prepared to sell a breakout. We're trying to get a bull breakout above a bull channel. 75% chance it's going to reverse within about 5 bars. Here, it reversed within a couple bars. If you have a channel that's reasonably broad, the legs going down, lasting 5 or 10 bars, then selling the reversal down makes sense. If the channel up is extremely tight, like this, selling a reversal down does not make sense. Probably the reversal will be minor, and the best the bears will get is sideways. Again, if the channel is very, very tight like this, the first reversal down is probably minor. You're not going to make much profit if you make any profit at all. The same right here, probably not much profit. But here, the bear legs are lasting 15 bars, 5 or 10 bars, and traders are making money selling at prior highs. If they sold this high and sold more higher, they would make money. The pullback here fell below the breakout point. Chances are, if you're selling here above these highs, at a minimum, we'll pull back below the breakout point. We have a bull trend, fairly tight bull channel. We sold off about 10 bars or so. Possibly this is a double top lower high major trend reversal. It's reasonable to take that short. It would be better if this bar had a bear body and if we had more selling pressure. Micro double top, that's good. That increases the probability of success. But this rally up to this bar is about 9 bars without a pullback. This is the first reversal down, the first time a bar went below the low of the prior bar. That makes this a lower probability short, even though it's a micro double top and a lower high major trend reversal. Bull channel, very tight. On a higher time frame chart, this would be a series of bull trend bars, and this would be a very brief breakout. We have one bear bar. If you take this one bear bar out of the chart, there's really not much selling at all. Again, a 10 bar bull micro channel. Probably the first reversal down will be minor, and the bulls will try to get resumption up. And then additionally, the sell signal bar has a bull body. Again, low probability sell. This bear breakout is below a tight trading range, but it's a 1 bar bear breakout. And look at the follow through bar. The next bar has a bull body, and the bar after that has a bull body. This looks like a failed bear breakout. That is not much selling pressure. We went sideways for about 10 bars, but the bars are small and the pullback is small as well. Therefore, there's not much sign that the bears are particularly strong. If you want higher probability, better to wait for more selling pressure or for a strong bear breakout and then sell after you see a very big bear breakout. And you can see what happened. Instead of a reversal down, we have a small double bottom bull flag and trend resumption up. If you had shorted below this bull bar, the market's still always in long. It never became short here. The bears did not get follow through. And therefore, if you sold below here, you have to exit above a bull bar. We have a double bottom bull flag and trend resumption up. We have a bull flag here, a break above the bull flag, and then a small bull flag after this breakout. You have to get out of your shorts here because this is exactly where bulls will get long again. If the bulls exited below this tight trading range with this bear bar, they'll buy again above a bull bar, above here, above here. If the bulls exited below this micro double top, it's still always in long. Therefore, they have to buy again above a bull bar, and they have a bull bar here. You cannot continue to hold short if the market is telling the always in bulls to get long. Bull trend, bear breakout, higher high. Is this a higher high major trend reversal? Well, look at this channel. We're up for 30 more bars. I think you have to start the process over and look at this as a new bull trend. And this is not much selling pressure. And therefore, this is probably a minor reversal. You can say it's a second entry short and went below this bull bar, tried to resume with this doji, and now we're getting a second entry short. I would not call this a higher high major trend reversal. I would call it a minor reversal. And more likely, we're going to go sideways rather than down. $20 bars in a very tight bull channel. I would call this a resumption of the bull trend. I would view this as a new bull trend. And therefore, I would need another sign of strength by the bears, a resumption of the bull trend, and a failure around the prior high. this reversal is more likely minor, and it probably will become a bull flag, and the bull trend will probably resume. Whenever you get a trend resumption lasting 20 or more bars, start the process over again. You have to again look for some sign of strength by the bears. If you did sell this and you were stopped out within 5 bars and then there's another sell signal later, that would be a higher probability sell, but that's not what's happening here, at least not yet. This is a strong bull trend, a tight bull channel. Chances are we're going higher. Eventually, every trend ends. However, there's no reasonable sign of a top yet. And a lot of times the market will make several attempts to reverse before it succeeds, trying to reverse here, 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 again here. But none of it is strong enough to lead to a trend reversal. Now this is good for the bears. They have a strong leg down lasting 10 or so bars with many bear bars, some big bear bars. After this, traders will look to sell a major trend reversal around this high. Maybe here, but you got 3 bull bars, one pretty big. Maybe here, 3 more bull bars, not very good. But here we have a bear bar closing on its low. We have another bear bar closing on its low, a micro double top, and a wedge. This would be a higher probability short for a major trend reversal. Reasonable to sell on a stop below the low of that big bear bar. We have a micro double top, and we have a wedge higher high, and we have good selling pressure on the part of the bears, and we have 3 pushes up, 1, 2, 3. Reasonably good breakout below the bull trend line, and trend resumption up. Even though we have a lot of bull bars, we're getting some hesitation on the way up, and we have a wedge rally. If you do sell below this bear bar, it's reasonable to put your stop just above the high of that bar. That is your initial risk from your entry below this bear bar right here to your stop just above. In this particular case, that's 10 ticks. This is a fairly tight channel and a new leg up, but it's within a broader channel, and you're getting much more selling pressure here, here, here. Therefore, there's a higher probability that the bears will finally get a major reversal, a couple legs and 20 or more bars down. Lots of prominent tails, all representing balance between the bulls and the bears. Bulls are selling at the highs of a lot of these bars. Bears are selling at prior highs. We're getting increasing selling pressure. And nested wedge. We have a wedge 1, 2, 3, and we're reversing down. You can also draw the wedge 1, 2, 3, trying to get a bull breakout above the wedge. You can draw the wedge 1, 2, or 2 and 3, or 1, 2, 3. I talked about tops needing strong bear bars. They need some evidence that the bears are strong enough to take control. And then I talked about minimum targets when you're taking profits. You should always go for at least 2 times your actual risk. And if your actual risk is small, then go for 2 times initial risk to take partial or full profits. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading major trend reversal tops. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading major trend reversal tops. Whenever you're in any trade, you always have to have a plan to take profits. Major top, so expect 2 legs sideways to down to some kind of a support level. Maybe this high or low, maybe here, maybe all the way to the bottom of this wedge. Plenty of room for a profit if we get down to the most recent major high or low. Major because it led to a new high and it had a lot of decent bull bars on the way up. It's still a bull trend as long as it stays above the most recent major high or low. However, at this point, a bear breakout, decent follow through, wedge top, the market's probably always in short and will probably get at least a small second leg down. This might be the second leg, this might be the second leg, or this could be the first leg and then a triangle and then a second leg. You don't know for sure until you see it play out. A trading range around a 50% pullback after a wedge top, that is common, but it's still reasonable to hold short. Part of the reason for this trading range is the bears who sold below this bear bar had a risk here, and 1 times their actual risk was here. Some of the bears took profit at 1 times actual risk because they were disappointed by these bull bars. They were afraid that instead of a reversal into a bear trend, it might simply be a bear leg into a trading range. It's reasonable to take your profits at 2 times initial risk, which would be down here. 2 times actual risk, I don't have it drawn in. You sell below this bar, you get filled here. Your actual risk is to just above this high. And this is probably around 2 times actual risk. It's reasonable to get out here. We have an attempt to reverse back up, probably a second leg down from this bear breakout. Well, this is a second leg down. It's reasonable to get out above this bull bar. Here we have a failed breakout below this small double bottom, and we have a micro double bottom. Also reasonable to get out above this bull bar. Even though it's only 1 times your initial risk and you really wanted 2 times, it's reasonable to get out. You can stay short, keeping your stop up here, maybe above the top of this bull bar. But if you stay short after the market is trying to reverse up like this, you have to keep your stop at the appropriate place. Don't panic out and just rely on your stop. Also, whenever you have a wedge top and you get a reversal, the reversal usually lasts about half as many bars as there were in the wedge. Here's how many bars in the wedge, and this is not quite half, and therefore we still might get more down. This might simply be a triangle pullback after the first leg down, and then triangle pullback, and then we might get a second leg down. Remember, most major trend reversals only have about a 40% chance of a swing profit. And it's always reasonable to take partial profits using limit orders at support. And one support would be 2 times actual risk. Again, actual risk is from your entry price to above the high of the pullback. And this would be around 2 times actual risk. You sell below this bar, you get filled here, this pink line. Your actual risk is to 1 tick above the high of this pullback bar. If you had a stop there, you don't know that in advance, but if your stop actually was there, that was the total amount that you actually risked from your entry price to that pink line, and 2 times actual risk is right here. Your actual risk was only 7 ticks, and 2 times actual risk is 14 ticks, and as long as it fell 15 or more ticks from your entry, you could exit at 2 times actual risk, and therefore taking partial or full profits right here makes sense mathematically, and that's part of the reason why we're reversing here. Bears taking partial or full profits. But look what happened. The bears who held short, relied on their stop, and they sat through all of this, got a windfall profit all the way down to the bottom of the chart. If you did get out for any reason, you have to be looking to sell again. You could sell on this strong bear reversal, 2 big bear bars, or you could wait until the close of this bar. At that point, the odds are high that we'll go at least a little bit lower. Whenever you have a wedge top, you're looking for 2 legs down, and if the legs look too small, then they're probably simply part of a bigger first leg. Then you look for a bigger second leg down. And therefore, it is reasonable to hold short even after these strong reversal attempts. Whenever you have a higher high major trend reversal, in this case a wedge, you always have to be thinking that it probably will be followed by a lower high major trend reversal attempt. We tried to get a double top bear flag here, a double top lower high, did not work. And then we have another attempt at a double top or an expanding triangle top for a lower high. Okay signal bar, but we went above it. Not really good stop entry selling unless you're going to use a stop up here. Tight trading range, 30 bars sideways. Nothing is clear until you get a couple strong breakout bars. If you sell at this point, higher probability, stop further away, less profit remaining in the trade, but reasonable to sell if you can react quickly. One of the problems is if the market's in a very tight range like this for 20 bars, it's easy to not be ready to trade. And therefore, when you get this breakout, it's hard to sell. But with experience, you can do that. Whenever you do get a lower high major trend reversal after a higher high major trend reversal, it often is basically a tight trading range. But within it, there's often some kind of a pattern, like an expanding triangle or a double top here, a bear reversal, and then a small wedge rally. If you're prepared for a bigger second leg down, you can be selling. Expanding triangle, and you could sell below this bar and put a stop up here. If I sold below this, I would probably keep my stop up here. You get two bull bars, a decent sized bull bar, might go a little bit higher. You're betting on a lower high major trend reversal and a second leg down after the wedge. I think the best stop is up here. A small wedge lower high after a bear reversal. If you want, you can call it a nested head and shoulder stop. Left shoulder, head, right shoulder, and the right shoulder subdivided into a smaller head and shoulder stop, left shoulder, and then a small double top for the head, and then a small right shoulder. Tight trading range, you can see all kinds of patterns. You can see buy patterns and sell patterns, but it's reasonable to take the short because there's at least a 40% chance you're going to get the bear breakout after the wedge top. There's a 40% chance you're going to get bull trend resumption up. And then 20% chance you may just stay sideways for a lot of bars, maybe to the end of the session. Again, if you're quick to understand what's going on, you just sell the close or simply sell at the market. A lot of times you don't have time to sell the close exactly. So when the bar is about to close or as soon as it closes or right after it closes, you just hit sell the market. The bulls are giving up, the bears are getting aggressive. You don't want to be looking to buy for at least several bars. Whenever the risk is small, for example, if you sell below this bear bar and put your stop above the high of that bar, you have low probability. In general, whenever you have a small risk, it's a mistake to put your stop right above the top of the signal bar. It's better to use a wider stop, measure move up, or look to the left for some alternative stop. Since we have a wedge top and two legs down are likely, it's reasonable to put your stop here. Also, the swing bears who sold up here and are holding short do not have a reason yet to use a tighter stop. If there's a strong bear breakout, then they can lower their stop. But all through here, the correct stop for the bears is still up here. If you did sell below this bear bar and you get stopped out, you got to look to sell again. For example, on the outside down, because at that point we have a micro oval top, or on the close of this bear bar. Anytime any stop is hit, there's a 50% chance that the bull breakout will continue higher, and 50% chance the breakout will fail and reverse back down. It's very common for the market to have strong moves in the wrong direction. In other words, they appear to be going one way, that attempt fails, and then you have an even stronger move in the opposite direction. Here you have a strong bear breakout, bad follow through, and we got a reversal back up. Experienced bears, instead of getting stopped out here, they'll sell. They see that people made money selling at this high. They made money selling at this high. They'll be selling at this high, putting a stop above here. This is the most recent major top, and therefore bears selling for any reason would put their stop up here. Again, half the time if a stop gets hit, the breakout will fail. It's simply the market probing, testing the strength of the bulls and the bears. Either you get a bull breakout and the bears give up, or you get a bear reversal and the bulls give up. In this case, the bulls gave up. As I said, you could put your stop above the high of this pair of bear bars. Weak bears will do that. Strong bears will keep their stop up here. And strong bears will be selling above bars. They sold at this high right here. They sold above this high right here. And strong bears will sell with limit orders at this high as well and put their stop right here. Weak bulls will be buying these breakouts, hoping that the trading range will convert into a bull trend. And that's usually the worst thing to do. Selling at the bottom, buying at the top. Strong traders do the opposite. They buy at the bottom and they sell at the top. There's simply not enough bulls to get the bull trend to resume, and the bulls are giving up and the bears are winning. And then this strong breakout is a sign that the bulls are finally giving up. This is a give up bar, a big bear trend bar, consecutive bear trend bars. And you can see when this bar opened, it opened below the close of that bar. Traders were selling. As soon as the bar closed, they sold. Same here. The open of this bar is below the close of this bar. Aggressive selling. Bears are selling to get short. Bulls are selling to give up. If you did hold for leg one, pullback, leg two, and now we're at the bottom of the entire bull trend, and we're getting a reasonably strong reversal up and a micro double bottom. We went down on this bar and then up, down on this bar, up again, and a pretty good bull reversal bar. It could be simply a two-legged move in a big trading range. Leg one, pullback, leg two. This could be a large second leg trap. It's reasonable to get out above the high of this bar. Even though it's probably a minor reversal, it could lead to an abrupt reversal. We were in a tight trading range here. So some strong bulls will buy at the prior low. They'll buy at this low, get filled here for a scalp. They'll buy at this low, they get filled here. And they'll buy at this low and they get filled here, and they do not panic out. Some bulls will hold short, and then when there's a strong bull bar, they'll buy more above the high of this bar, expecting the market to come back to their original entry price, which it ultimately did. If you sold here and you took profits here, you made about 8 points. Can you wait to take profits? If you do, at this point, I think you have consecutive good bull bars. You have a reversal up from the bottom of a possible trading range. It's reasonable to exit there or even exit here. If you did not get out here, I think you have to get out here, and certainly no worse than here. We have a bull bar, a bull follow-through bar, even though it's a doji. You have to have a reason to get out. And the market is probably always in long at this point. I think it's almost certainly always in long at this point. That means we're probably going at least a little bit higher, and you don't want to take a chance that you're going to give back all of your profits. This is probably the best exit. We're reversing up from the bottom of the chart, possibly the bottom of a trading range, and trading ranges often have two legs, one pullback, two, and the second leg is often very strong, making traders believe the trading range is converting into a bear trend, when in fact it could simply be a second leg trap, a very strong second leg trapping traders into selling at the bottom, and then the market reverses up. You have to be prepared for that. If you have a big windfall profit like this, you have to take at least partial profits. I would get out of everything above a good bull bar, micro double bottom, failed breakout. Bull trend, bear breakout, higher high, major trend reversal. We have a 20 or 30 bar very tight channel. This is probably a minor reversal, which means the best the bears probably get is a trading range and not a bear trend. It's pretty common when you take a short to have the market come all the way back to your entry price. Part of the reason for that is the bulls will look at this and say, it's a minor reversal. I'm going to buy the low of that bar and put my stop down here, betting that the reversal will not get down here, and I can buy more lower if it goes down, and I can get out break even because it's probably going to reverse up and form a trading range. If a bull buys here and it goes right up, he makes his profit. If he buys here and puts a stop down here, he can buy more lower, betting that it'll come back and test his original entry price. Very common for the first reversal up to go up to the low of the sell signal bar, which is one tick above your entry price. You enter one tick below that bar. It's very common for the pullback to hit your entry price and stop you out if you have a break-even stop. Strong bears, if they're expecting a major trend reversal, they'll rely on their stop above the top of the bear trend, allowing for the possibility that this is simply a test of the breakout price, a test of the entry price, trapping weak bears out. However, if you see a strong reversal like this, a strong bar like this, and now we're getting a third reversal up, we're still forming a higher low in a broad bull channel, you have to get out. You could get out above this bull bar. It did not go above this bull bar, but now we're getting another reversal attempt. So had you shorted this, hoping for a swing down, you have to get out on some kind of reversal. Here you got a third push up, a small expanding triangle. Here you have a bull bar. I would definitely get out above that bull bar if I did not get out above here or above here, because this is probably a minor reversal, not a major reversal. There are too many bars up since the first bear break below a trend line, and therefore you have to start the process over again. Whenever the market comes up and hits a break-even stop, and then the bear trend resumes like this, you never want it to get back to the break-even stop a second time. If it does get there, you're usually going to get higher prices. We have a gap up and a bull trend, and we're working higher. We have a new high here, a first reversal down, and now we're getting a second reversal down. You can argue wedge top, 1, 2, 3. However, look at the channel, this rally. How much selling pressure is there? We got 3 bars here, 3 bars here, 3 bars in the pullback here. But how deep are the pullbacks? How big are the bear bars? The pullbacks are very small. This is a small pullback bull trend, and selling reversals from a new high probably will result in a minor reversal and a resumption of the bull trend. Bull trends are always forming wedge tops. Bear trends are always forming wedge bottoms. 80% of them fail. Weak sell setup, certainly for a stop entry short, and therefore it's a bad sell. Better to wait for a stronger sell setup. Almost certainly there are more buyers below this sell signal bar than sellers, and we're probably going higher. They bought at the low of this bar, made money, even though it pulled back a few bars. They bought at the low of these bars and made money, even though it pulled back a few bars. And that's probably true here as well. They'll buy below that bar, buy below this bar, betting that the bear reversal attempts will fail and the bull channel will continue higher. We have a bull trend, a buy climax, and a couple legs sideways, maybe a triangle, 3 pushes down, 1 pullback, 2 pullback, 3 pullback, and trying to resume up. And now we have a small double top, higher high, major trend reversal, and a second entry sell. First entry, second entry, even a third entry sell. Now, is this a good major trend reversal setup? You could say, well, Al, it broke below the bull trend line and went sideways about 5 or 10 bars. Yes, but how close did it get to the moving average? Where are the consecutive big bars? We have a pair of consecutive big bars here, but this is probably a pause after a buy climax, and then we have trend resumption up. Not much selling pressure at all. The pullbacks are small, lasting 1 bar, lasting 2 or 3 bars, and they're not falling very far at all. This is a small pullback bull trend, and on a higher time frame chart, it's a bull breakout. On a higher time frame chart, this looks like this, and it's a low probability bet when if you're looking to sell. Calling this a higher high major trend reversal is a mistake. It's not a major reversal. It's a minor reversal, and a minor reversal usually becomes a bull flag or a trading range. A minor reversal, you get trend resumption up. Minor reversal, trend resumption up. Minor reversal, trend resumption up is much more likely than trend reversal down. The market has not touched the moving average in 20, 30, 40 bars. So a 20 gap bar buy setup. Probably bulls will buy the first touch of the moving average. A weak sell setup, and therefore better only to look to buy. And you can see when it got down to the moving average, you got 4 consecutive bear bars, all closing below their midpoints, but there were buyers at the moving average. And now we have a high 2 bull flag at the moving average. These are buy setups, not sell setups. Also, we have a negative gap this low, barely pulled back below this breakout point, and a negative gap common in small pullback bull trends. Traders will buy the resumption up, looking for some kind of a measured move up. Whenever you take any trade, you should always have some idea of where you'll take profits and under what circumstances you'll take profits. You always need a plan. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on trading major trend reversal tops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading major trend reversal tops. In this video, I'm going to talk about lower high major trend reversals. We have a gap up, which is a type of a bull trend, even though it's only a gap and very brief. If you looked at the cash index, you would see a big bull trend bar from here up to here. And therefore, it's a strong bull trend, a strong breakout. While the bulls were strong enough to create a big gap up, they were not strong enough to get good follow-through buying. We have 11 bars down, many good-sized bear bars, consecutive bear bars here, 3 bear bars here, 2 closing on their lows, both with good-sized bear bodies. This is pretty good selling pressure, a pretty good sign that the bears are reasonably strong, despite the big gap up. And because that's the case, the market might be in a trading range instead of a bull trend. And if it's in a trading range, a rally up in that range could lead to the beginning of a bear trend, a reversal. The market's rallying, and we have a low 2 short, low 1 here, low 2 there, but a very tight bull channel. And usually when you get a reversal down in a very tight bull channel, the reversal is minor. Is this a lower high major trend reversal? Of course, we have a bull trend. We have pretty good selling pressure, and now we're rallying to a lower high. However, because it's in a very tight channel, it's more likely a minor reversal and unlikely to lead to a bear trend at this point. For the bears, they can take this sell, but the probability is not yet particularly high because this channel is tight. For the bears, they see this as a double top with either this high or the top of this sell climax. Very often when you get a sell climax like this and you get a reversal, the market tries to get a little bit above the top of the sell climax, and the bulls who bought the sell climax will take profits there, and the bears know the bulls will take profits, and the bears start to sell there as well. This is also about a 50% pullback from what the bears hope is the start of a bear trend. Both are reasonable reasons for traders to start to look to short. If they take that short, their initial stop is at the top of the strong bear leg. Here, the market did sell off, and many bears, because they think we have big up, big down, big confusion, and a trading range, if they sell here, we'll take profits around this low, thinking that we might get a double bottom and then a leg up in the trading range. The initial target for these bears is this low. In general, when you trade a major trend reversal, you have about a 40% chance of a swing profit. This is a good example of that. Despite the very tight bull channel, the bears were able to get down to a new low. In fact, they even got lower. And had they held, they would have had a reward that was many times greater than their risk. They sell below this bar, stop probably up here because we might get 1 more or 2 more pushes up after a very tight bull channel. Yet the math is worth it. Their initial risk is up here. Their actual risk, had they sold below this low, would have been 1 tick above the high of this bar, so their actual risk was tiny. And their reward at this point, partial profits at the new low, several times greater than the actual risk. And the final profit, if they exited down here or at the end of the day, would have been many, many times greater than their actual risk. And therefore, taking a trade that only has a 40% probability of success makes sense. Even if you get a swing profit only 40% of the time, it more than offsets the low probability of the trade. This is also a good example of how a reversal that's probably going to be minor is sometimes major. And therefore, it is reasonable to take the short and hold it for a swing. If you want a higher probability trade, instead of taking this short, you wait for a strong bear breakout with pretty good follow-through. And unfortunately, you did not get that anywhere down here. We have a bear breakout to a higher low. It failed. And then we have gaps, this high, that low. Another attempt to get back above this low. And it's unsuccessful. A trader who notices that the limit order bulls who bought at this low were unable to get out with a profit. We did not get above the low here, did not get above the low here, and now we have a double top bear flag. This is, I think, a higher probability short, because now you have a gap and you have trapped bulls who are desperately hoping for any kind of a rally to get out without a loss, and they will give up. Usually they'll give up when a low 2 triggers after the gap. Low 1, low 2. As I said, the actual risk was tiny. It's from your entry price, 1 tick below this bar, to 1 tick above that bar. That's all you had to risk to take this trade. You did not know that when you put the trade on, but once the trade starts to go your way, you do know that your actual risk was very, very small. Once you get a new low and there's reasonably good momentum in the sell-off, here, a very tight bear channel, traders will change their stop from up here to above this high, because they'll see this as a major lower high. As long as the market stays below a major lower high, the bears have a chance of a continued bear trend. The bulls wanted to get a double bottom here. They tried, but they failed, and the market continued down. Therefore, another target on the downside is a measured move down from the potential double bottom. If the market did rally from this double bottom and broke above this lower high, traders would be looking for a measured move up. Whenever there's a potential double bottom like this, and instead of going up, it goes down, traders will look for a measured move down. And you can see what happened when the market fell to a measured move down. There were profit takers, and that led to this reversal. This reversal ended up forming simply a double top bear flag with this high. This is a reasonable place to take profits, either final or partial profits. We're at a measured move target, and we have a potential final flag, a low 2 late in a bear trend. We might get a bounce up. Because the channel is so tight, the reversal up will probably be minor. However, it could go up fairly far because we're at a significant support level, a measured move. Plus, we're testing yesterday's close and yesterday's low. And we have a potential final flag. And if you want, you can look at it as a wedge, 3 pushes, 1, 2, 3. Is this a major lower high? We have a strong breakout and a new low, but this is not much of a rally. Therefore, this might not be a particularly major lower high. When I look to the left, the most important lower high is still here. So theoretically, the bears can hold short even if we break above this high and this high, relying on this as their major lower high. During this rally, the bears still have a reasonable argument that we're in a broad bear channel, as long as the rally does not get above this high. Again, this is a minor high. This is a minor high. This is a minor high. Because there was only a brief reversal up before the new low, I view this as part of this bear channel and this as the beginning of the leg down. If you look at a higher time frame chart, a tight bear channel like this is just a series of trend bars, bear trend bars. So this is still a breakout phase, even though we're getting repeated reversal attempts on this chart. Do the bears get out on the stop above here? Well, I think if you're thinking about getting out above a minor reversal, it's better to get out maybe here, a second reversal up, first reversal up, pullback, second reversal up, sell climax, late in a bear trend, a potential final flag. Therefore, if I'm choosing whether to get out early or late up here, those are my reasonable choices. This is not a reasonable choice, because if the market goes above here, a minor high, it's probably not going to lead to a bull trend. It's probably only going to lead to either a trading range or a double top bear flag, which it did here. So this is not a really good exit location. If you're thinking about exiting before it gets above a major lower high, it's better to exit on the reversal up early and then look to sell again on a reversal down. I sometimes refer to this as a skunk stop, because skunks get killed when they're in the middle of the road. And the middle of the road is either taking the early exit or the wide exit, and taking any of these minor exits in between is going to cost you money. Whenever the market's in a trend like this, bears will get out on reversals. Some bears might get out up here. I would not. If anything, I would be looking to sell again, because it's only a minor lower high. Had a bear gotten out, he would have to look to sell again. And typically he'll sell below a bear bar. And here's a bear bar, or here's a bear bar. Those are two reasonable locations for the bears to sell again. If you sold for any reason here or below here, and you conclude correctly that the market's always in short, and then the market tries to reverse with the minor reversal, if you get out, here's another second entry reversal, first entry, second entry. You have to sell again below a bear bar, especially a second entry. Here's a first entry, here's a second entry, and this one has a bear bar. This is where the bears sell again, and this is where the bulls who bought give up. They might buy above here, maybe they buy above here, but when they see the bear trend resuming down a second time, they exit, and that usually is a profitable trade for the bears, a low too short and a bear trend. This is an impressive breakout on the part of the bears. You have 7 bars without a bull body. You have 4 bear bars with decent sized bear bodies, and it's the strongest series of bear bars occurring at least 20 bars into the trend, at least since here. And when you have the strongest bear breakout occurring late in a bear trend, it's more likely an exhaustive move, and the bears need to take a break. They'll buy back their shorts and look to sell again later. The top of that sell climax is a magnet, and therefore traders know that at this point the market's probably going to try to test this high. It probably will close the gap between these lows and these highs, which it did. Probably will get to this high, and the bulls who bought for a scalp, betting on a minor reversal, will take profits, and the experienced bears will sell again, arguing that even though it might be always in long here, it's still in a broad bear channel unless it gets above a major lower high. The same thing here. We have 4 consecutive bull bars, 2 with good bodies closing on their highs. The market might be always in long, but the reversal is minor because it's coming after a 10 or 11 bar very tight bear channel. Here, always in long. Here, probably always in long. But unless you're starting to form a series of higher lows and higher highs, this always in long and this always in long can still be in a broad bear channel, and therefore bears will look to sell the reversal back down, especially below a bear bar. Here we are at the end of the day. We have a bull bar closing on its high. Most bears would exit on a stop above the high of that bull bar, and if they did not, they would exit a few seconds before the end of the day. A lot of traders never worry about picking an exact top or an exact bottom. They use wide stops and they scale in. Pretty good selling pressure, a tight bear channel, 11 bars down, 3 consecutive bear bars closing near their lows. Again, the sell climax, so the top of the sell climax is a target. Think about what's going on here. We have a gap up, very good for the bulls, and then an 11 bar bear channel with several bear bars closing on their lows, good for the bears. We have big up, big down. That creates big confusion, and we're probably going to go sideways for a while. You can argue that we were sideways all the way to here. Also for the bulls, this is about a 50% pullback from this gap up, and it's a breakout test of this prior high. So it's at a support level. Traders expect a bounce. However, after big up, big down, they expect big confusion, which means a trading range, and that means they expect the first rally to not lead to a bull trend. They expect it to be sold and for the market to test back down. What they don't know is, will it form a double bottom and the bull trend will resume from a double bottom bull flag, bull trend, double bottom, and a resumption up, or will this lower high be the start of a bear trend, a lower high major trend reversal? What they do know is big up, big down, big confusion, and therefore probably a trading range for 20 or more bars. And that means that any rally will be a bull leg in a trading range, and it should be followed by a bear leg in the range. But it might be a lower high major trend reversal leading to a bear trend. In either case, traders are going to look to sell rallies. A very tight channel like this, probably the first reversal down will be minor and bulls will buy it. And they did try to buy it. They bought it here, they bought it here, they bought it here, but not enough bought it to create the double bottom. And instead, we ended up trending down. We have 3 consecutive bear bars, 2 with big bodies, and all 3 closing on their lows. This is a bear breakout. Even though we reversed up to above the top of that bear breakout, it's still strong enough to make the market always in short. Some bulls will see this as always in long. However, this is a strong enough sell-off to make traders believe it's always in long, and the first reversal up will probably form a lower high and will probably come back down to test this close at a minimum at some point within 10 or 20 bars. If a trader sold the absolute worst price, like this close, if he manages his trade well, he'll still make money. He knows the channel down is tight, and therefore the first reversal up is probably minor, and that the market will probably test back down to this area. So even if he sells this close and uses a stop above the top of the sell-off, he can make money if he sells more higher, like at a 50% pullback or on a reversal down. And then he can exit part or all at his original price. He gets out break even for his entry down here, and he exits with a profit if he sold more here. That's for a scalper. A swing trader would hold until there's a clear reason to buy again. Strong bull trend, strong bull breakout, but a 1 bar final flag, a pause bar. You can argue parabolic wedge, 1, 2, 3, a small double top, possibly a second leg trap. This looks like a bull leg in a trading range, and then suddenly we get an exceptionally strong bull leg. Strong bull breakout, and it failed. I talk more about this in the videos on trading failed breakouts and climactic reversals, and in the videos on trading the open. Remember, this is early in the day. The day is just starting. We have a very strong breakout on the open. 50% of the time, if you get a strong breakout up or down on the open, it's the wrong way and it will reverse. As strong as this is, do not assume that it's the start of a bull trend. 50-50 chance it is, 50-50 chance it'll be an opening reversal. Rally to some resistance level, we don't see any right here, and then an early high of the day leading to a bear trend. For the bears, they're going to take a chance. They see pretty good reversal down here. We have 5 consecutive bear bars here, a decent sized bear bar here, good follow through here. Traders who see this see big up and pretty big down, and therefore they expect a trading range. That means that traders will sell any rally after this much of a reversal down. Some traders will sell for a scalp. Others will take a chance that it's a lower high major trend reversal and that this is simply a bull trap on the open and that this is the start of a bear trend day. So it's reasonable to short, especially below a bear bar. You can call it a wedge if you'd like. 1 push up, pause, 2nd push up, pause, and 3rd or 4th push up. And now we have a micro double top. And it's a breakout test of the bears who sold below here or here. Possible lower high major trend reversal. 40% chance traders will get a swing down. In general, you could put a stop here because of the micro double top, but a lot of traders would keep their stop up here at the top of the bear leg just in case we go up a little bit higher. Had you sold below the low of this bar, your initial risk, if you put the stop here, would be from your entry price here to there. So it would be that height. and this would be 2 times your initial risk. If you were to sell here and exit here, you would be getting out with 2 times your initial risk, and initial risk is always bigger than actual risk, and therefore you'd be getting out with at least 2 times actual risk, and the math would be okay. So it would be okay to sell here and take profits here. That would be the minimum mathematical thing to do. When the initial risk is small, as it is here, you sell below here. If you put the stop here, your initial risk is small. It's usually good to go for a profit that is at least twice your initial risk. Mathematically, all you have to do is go for a target that is twice your actual risk to have a positive trader's equation. However, if the actual risk is tiny, going for a reward that small is probably not the best decision. I always make the analogy to working for a minimum wage. Is it acceptable? Sure. But is it ideal? Should that be your goal? No. And the same is true with trading. There are things that mathematically make sense. However, if they're minimums, they're not necessarily the best. Whenever there's a strong buy climax like this, there's a big magnet at the bottom of the buy climax and the bottom of the bull leg. And therefore, some traders who take this short will hold, looking to take partial profits at the bottom of the buy climax. Also, we have a developing trading range. If you want, you can call it a double top. You can call it a wedge rally. Swing traders should always be looking for swing targets. And usually when you take the trade, the targets seem unrealistic. And what you're saying is, well, maybe I only have a 40% chance of reaching those reasonable targets. And that's okay, because the targets usually are many times greater than your risk. And if you win only 40% of the time, you will make money. You can look at this as a wedge. If we get a bear breakout below the wedge, maybe we'll fall for a measured move down. You can look at it as a double top. Here's the neckline. Here's the measured move down. You could look at it as simply a trading range. And if we get the breakout, maybe we'll fall for the measured move down. If we do get to this measured move, it's very close to the bottom of this buy climax, which is also a magnet. We'll probably get down here as well. And therefore, you might, instead of taking profits at the measured move target, hold for a test of the bottom of the buy climax. The market often makes a two-legged move, a leg one, pullback, leg two measured move, and it comes out here around that measured move target. So it looks like some bears will be taking profits around here. And you can see what happened. When it got down to the measured move target, it reversed up. It's also fell a little bit more than the leg one, leg two target. It never reached down here. If you did not exit partially with a limit order here, if you did not exit partially at 2 times your initial risk, you have to be thinking about exiting above this bull bar. You have a micro double bottom, a bull bar closing on its high, a failure to get all the way down to the bottom of the buy climax. Remember, the bulls are hoping today's a bull trend day. When they see this and then this, they start thinking, okay, it's probably not going to be a bull trend day, but maybe it can be a trading range day, which means a very deep pullback and then a test back up near the high of the day. And therefore, bulls are looking to buy. And they especially want to avoid the market falling below the bottom of that buy climax, because if it does, then the bears have a reasonable chance at a continued trend down. If you see the reversal up with a bull bar closing on its high, most bears, if they did not get out here, will get out there, even if they were hoping to get out here or here. They know there's too much risk that this could be a second leg trap in a trading range day. First leg down, and then an even stronger second leg down, and then we're trying to reverse up. So for the bulls, it's a high two bull flag. Leg one, pullback, leg two, and a higher low. So buying back shorts above this bar makes sense. The bulls still are above the bottom of the buy climax, and it's possible that this is the start of a big bull trend. More likely, big up, big down, big confusion, and the day will end up as a trading range, and whatever rally we get will be a bull leg in that trading range. Also, the bear trend might resume. It did not, but it might. Strong rally and reversal down, but did not get below the bottom of the bull breakout, and therefore it could simply be a deep pullback instead of a bear trend, we could end up in a trading range. At this point, traders are hoping for a bull trend, and they're confident that the first reversal down to here or here probably will be bought. Always reasonable to take half off at 2 times initial risk. Always reasonable to take part or all off at measured move targets. Always reasonable to take part or all off at the bottom of the buy climax or the bottom of the strong bull leg. But if it gets to any of the reasonable targets and starts to reverse up strongly, it's usually good to exit and then look to sell again higher if you're still interested in selling. Some traders would have a limit order to take profits at the measured move, or at least partial profits there. And you can see a lot of traders did that. That's what created this tail. And then once the traders saw this tail, a lot of traders said, uh-oh, maybe I should have taken profits at that measured move target. I'm going to place my order a little bit higher. The traders who did not exit here, a lot of them placed an order a little bit higher to take their profits, and that's what caused that. The bulls also saw that they were able to do this, and they got confidence that maybe we'll stay above the buy climax low, and they decided to buy more aggressively after they saw this reversal up. They bought below this bear bar, and enough traders bought, both bulls and bears. Bears bought to buy back shorts, bulls bought hoping for a swing up, and enough traders bought so that we did get a reversal. For the bulls, it's still above the bottom of the buy climax, and therefore a higher low, and what they hope is a bull trend, but after big up, big down trading range, much more likely. Bear leg in a trading range usually means you're going to get a bull leg in a trading range, so it's reasonable to buy to go long. We have a bull trend and then a trading range. We have a bull breakout above the range. If you want, you can call it a higher high major trend reversal. Then we get a reversal down, but then again another reversal up. This entire 50 bars is in a trading range, and it's getting many reversals, and most reversals fail. This top failed, this top failed, this one failed, this one failed, and now we're trying to resume up. We had a double bottom, another double bottom, did not go very far. We're trying to reverse up here, did not go very far. In a trading range, most breakout attempts fail, and you get repeated reversals. There are different ways to look at this. You can call it a wedge, 1, 2, 3, and a bull breakout above the wedge that failed and reversed down. You can call it simply a trading range and a higher high major trend reversal, a parabolic wedge, 1, 2, 3. In any case, we're trying to rally strongly and we are reversing. Lots of selling pressure here, here, and then especially here and here. This is enough selling pressure so that the bears have a reasonable chance of getting a trend down. The bulls have a trend up, and now it's very balanced, and the bears are very strong. Therefore, traders will start to look for a swing down. A strong break below the bull trend line, and a wedge rally, up, down, up, down, up, and starting to go down. A 2-bar reversal, a bear bar closing on its low. If you want, some traders will look at it as a double top, lower high. In any case, it is a lower high major trend reversal, and it's a reasonable swing short. The worst the bears expect is a continued trading range and a test near the bottom of the range, and they're hoping that it's the first of many lower highs and the start of a bear trend. If you take this short, it's reasonable to put your stop just above the high. We have a wedge and a good bear bar, or you could put your stop above the top of the bear trend, or what they hope is the top of the bear trend. If you short below this bear bar, I don't like to short below bull bars. I prefer to short below a bear bar closing on its low. So this is where I would short. If I shorted and I used a stop here, my initial risk would be the height of this brown box, and 2 times my initial risk would be here. And that's always a reasonable location to take partial or full profits, especially since it's at the bottom of a 50-bar trading range. Trading ranges tend to reverse at new lows and reverse at new highs, and therefore there's a pretty good chance we'll get some kind of a bounce up down here. Mathematically, it's good to take profits at 2 times initial risk. Remember, the minimum reward that you want is 2 times actual risk. Had you sold below this bar, you would have been filled here. If the market goes down, your actual risk is only right here. exiting with 2 times actual risk is probably too small given the size of the legs here. A bear who sold here, trying to exit at 2 times initial risk, has a limit order to buy back his shorts here, or he may simply place a limit order to buy back his short here, thinking that we're at the bottom of the range and it could reverse up. What do you do when the market is trying to go down, 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 but losing momentum? The bear bars are getting smaller. We're starting to get bull bars closing on their highs here, 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 and we've been in our trading range for 50 bars. This is a problem for the bears. They have a bear spike and a pullback. They're hoping for a channel, 3 pushes down, 1, 2, 3. And what they got was 3 pushes down, 1, 2, or 2, and 3, but they could not get below this low. And this is starting to base out. It's starting to go horizontal. Very strong bear breakout, terrible follow through, more bad follow through for the bears, more bars closing on their highs, bad follow through. Here, we have a bear bar and a doji bar, a bear bar and a bull bar, a bear bar and a bull bar. Therefore, there's a lot of bad follow through for the bears on the way down. There's bad follow through for the bulls on the way up. Bull bar, bear bar, bull bar, bear bar, bull bar, bear bar, bull bar, bear bar. Trading range behavior. And now we're starting to get trading range behavior again after what the bears hoped was a lower high major trend reversal and a strong breakout. And they hoped this was the start of a bear trend, but terrible follow through. Bottom of the range. What do? You took the short, thinking 40% chance of a swing down. Now, this is making you wonder if your premise is correct. If you begin to think that your premise is no longer valid, you have to exit your trade. And it's reasonable to exit here. We have a wedge bottom, a higher low, terrible follow through after the initial sell-off. So it's reasonable to exit here. And is that a scalp profit or a swing profit? It doesn't matter. It's not what you hope to get, but it's a small profit. I would call that a break-even trade or a small profit trade. But that's what you get 60% of the time when you trade major trend reversals. You don't get a swing trade. You either get a small profit or a small loss. The market continued sideways, and we're reversing up a third time. First reversal up, second reversal up, third reversal up in a sideways market, and therefore it's a triangle. And we're reversing up from the bottom of the triangle. Another bear breakout attempt to a higher low, followed by a bull inside bar. Some bulls would buy above the high of that bar and get filled here. Others would wait for a second entry and buy above this bar and get filled here. I talked about lower high major trend reversals in this video, and like all major reversals, they have about a 40% chance of leading to a swing profit. By a swing profit, I mean at least 2 times your actual or initial risk. Usually you're looking for at least 2 legs and 20 or more bars. You get that about 40% of the time if you pick the right entries. Getting that only 40% of the time greatly offsets the low probability. It's a profitable strategy. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on trading major trend reversal tops. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on trading major trend reversal tops. Some traders do not like taking trades where the probability of success is only about 40%. And therefore, they do not take the early entry in a major trend reversal. They wait until after there is a strong breakout, because at that point, the probability of making money is higher. We have a bull trend, and we have a series of bear bars breaking below a bull trend line, and now we're forming a lower high. Some traders will take that short, taking a chance that it's the start of a major trend reversal down. However, the probability of a swing down at this point is not all that great. We've been sideways for about 30 bars, and we're in a tight trading range here. For the bears who do take that short, they'll look at this and say, okay, 7 bear bars, several good closes on the lows. I'll short and put a stop above this high and take a chance that we get a swing down. That is a reasonable thing to do, but only about a 40% chance of success. Some traders do not like to win only 40% of the time, and they prefer higher probability trades, and they instead would wait and not take this short. An 8-bar tight trading range inside of a 20 or 30-bar trading range. Minor reversal likely. It's more likely that we'll just stay sideways, but 40% chance we'll get a swing down if traders put a stop up here. And that turned out to be the case. This is the 40% of the time when the market had a swing down. If a trader wants a higher probability short, instead of shorting here in the middle of this trading range, in this tight trading range, he'll wait for a strong bear breakout below here. For example, we have a bear bar, consecutive good-sized bear bars, and then we're getting another pair of bear bars here. At this point, we've had 5, 6, or 7 consecutive bear bars. It's higher probability to short either here or down here. After a trader sees this, he knows that the first reversal up probably will be minor, and he could look to sell below here. It's a wedge. We went up, we went down, we went up, we went down, we went up. So there's a wedge bear flag at the moving average after 7 consecutive bear bars, probably going down at least a little bit lower, and therefore this is a relatively high probability short for at least a small move down. Now we have consecutive very big bear trend bars, and we have a follow-through bar and another follow-through bar. This has a high probability of leading to at least a small second leg down. So this is a high probability short. It's a bear break below what the bulls hoped was a high 2 bull flag. Strong bull trend, first leg down, pullback, second leg down. So they're hoping for a double bottom, higher low, and a rally. Instead, we got a breakout, and not just a breakout, but a strong bear breakout, a pair of very big bear bars, and follow-through bear bars. Therefore, traders will be thinking about a possible measured move down. The bulls were hoping for a double bottom and a breakout above this neckline and a measured move up. Instead, we're getting the bear breakout. Bears will be thinking this is possibly a measuring gap or a measured move down. So instead of a measured move up from the double bottom, the bears are looking for a measured move down from the double bottom. Here's the double bottom attempt, the bear breakout. Here's the neckline of the double bottom. The bulls want a measured move up. Because we're getting the breakout, the bears want the measured move down from the top to the potential double bottom and then down here. And you can see where the market ended up, almost exactly to a measured move down. For the swing traders, this reversal is probably the earliest swing short. Maybe you could sell up here, possible final flag early in the day, hoping that you're getting an early high of the day. But later entries here, here, or here often have higher probability. In any case, with any trade, the math is always reasonable if you hold for at least 2 times your actual risk. However, many trades have potential of much bigger profit, and it's usually better not to go for the minimum. Traders looking at this are saying, do I sell here? There's a low 2. Do I sell here? Do I sell here? Do I sell here? Where's the best entry? There is no best entry, and every entry is a trade-off between risk-reward and probability. The earlier entries tend to have a closer stop, so the risk is less. There's more profit potential, so the reward is greater. So the earlier entries tend to have a much better risk-reward. However, they also tend to have lower probability. The later entries have a much higher probability of success, but the stop is usually further away, and there's less profit remaining in the trade. Both are mathematically acceptable trades. It usually comes down to personality. A lot of traders will add to a winning trade. There's no reason to get out here. Maybe you can get out here, but if you do, you got to look to sell again. Strong enough up, a lot of bears will not take the first reversal down. However, they will take the second reversal down, even though it's a bull bar. It's a low 2 short at the moving average. This is not enough for a major reversal, and therefore it's a double top bear flag. It's a reasonable short. And bears who sold here, if they did not get out here, they might sell more here or here. If they did get out here, we're still always in short. The bulls have not done enough to make it always in long. They have to get short again if they're trading always in, and a double top bear flag, a low 2 at the moving average, is a reasonable time to get short again. If a bear took any of these shorts, let's say he took an early one and he sold more here or here or here or here, he's scaling into a winning trade. He's scaling into a trade where he already has a profit. The minimum goal for any trade is a profit that is at least twice your actual risk. You don't know what your actual risk is when you put the trade on, but once the trade goes your way, you then know what the actual risk is. For example, had you sold below the low of this bar, and then you see this bear breakout, you discovered that your actual risk was to just above the high of this bear bar. So your actual risk was the height of this brown box. Here's 1 times your actual risk. Here's 2 times your actual risk. Mathematically, it's acceptable to take your entire profit right here at 2 times your actual risk. That is the minimum acceptable profit to get a positive trader's equation. But like everything in life, doing the minimum is rarely doing the best. Again, if you sold below this bar, and the market broke strongly to the downside here, at that point, you discovered that your actual risk was only from just below this low to 1 tick above this high. You had a very small actual risk, and therefore, this is 2 times actual risk right here. And if you exited your entire position right there, and you did that on 100 trades, you have a very high probability of making money. But again, exiting with the minimum is rarely the most profitable strategy. Same thing here. If you sold below the low of this bar, your actual risk is to just above the high of this bar. You discovered that after this bear breakout, and 2 times your actual risk is right there at that bear close. It's reasonable to exit there, but it's probably not ideal. When the actual risk is tiny, like here, here, and here, exiting at 2 times actual risk is usually not a good strategy. You have much more profit potential, and it's usually better to hold for a bigger profit. Same thing here. Actual risk, you sell below that bar, you get filled here. The market breaks to the downside. You now know your actual risk was only from your entry price right here to 1 tick above this bear bar here, 2 times actual risk here. Some traders have a scalper's mentality and they keep taking quick profits, 2 times actual risk, and then sell again. Very difficult to do because what you'll find is you don't take all of the entries, and therefore you will not make nearly as much money as a swing trader. I talk more about this in the video on trade management and taking profits. A lot of traders do not pay attention to actual risk, especially if it's small, and they set their target at 2 times initial risk. Initial risk is based upon their initial stop. For example, had you sold below this bar and put a stop just above its high, your initial risk was 1 tick below this bar to 1 tick above that bar, and this is 2 times initial risk. Same here. Sell below this bar, stop above the high, that's your initial risk, here's 2 times initial risk. It's always at least as big as actual risk, and it's usually bigger than actual risk. And that is usually a better strategy, so it's always good to take profits at 2 times initial risk. However, it's not always best, and if the initial risk is small and you have the potential for a very big profit, it's usually better to not exit at 2 times initial risk. It's reasonable to take half off or part of your profits at 2 times initial risk. However, if the potential for profit is much greater, a lot of traders will continue to hold their entire position until they believe their premise is no longer valid. If their premise is that the market's in a strong bear trend, they'll continue to hold short until they think it's no longer in a strong bear trend. Had you sold here and had not taken any profits along the way, Here, a pretty good bull reversal bar, a double bottom, a second failed breakout below the bottom of yesterday. It's reasonable to take partial or full profits here. But if you do, the market did not get always in long here or here. You have to be thinking about selling again below the low 2 at the moving average. Initial risk for the bears who sold below this bar, their stop is probably here, and this is 2 times initial risk. It did not get down to their initial risk by the end of the day, and if that was their goal, they would exit at the end of the day. Again, it's reasonable to hold your position until either the end of the session or until there's a reasonably good buy signal. The market keeps trying to reverse. Every trend is constantly reversing. On the way up, the market tried to reverse repeatedly. On the way down, it's trying to reverse repeatedly. But when the market's in a fairly tight channel like this, 80% of the attempts to reverse up will fail and become bear flags, and the trend will continue. Every time there's a strong breakout to a new low, traders will tighten their stops because here you get a strong breakout to a new low. Therefore, this high is important. It's major. And as long as the rally up stays below the major lower high, the premise of a strong bear trend is still intact. And therefore, once you have a strong breakout to a new low, traders will tighten their stops to above that high. If it gets above that high, then the premise of a strong bear trend is no longer valid. The market's then either in a trading range or in a bull trend. And if you're holding on the belief that the market's in a bear trend, then it should not get above this high, and therefore it's reasonable to put your stop there. Strong bear breakout, reasonable to lower your stop to here. This then becomes a major lower high. After this close, it's a strong breakout to a new low in a bear trend. If the bear trend is going to continue, it should not get above this high, and therefore you can lower your stop from here to here. Strong bear breakout to a new low. If it's in a bear trend, it should not get above that high, and therefore you could lower your stop from here to here. And that does not matter whether you shorted here or shorted here or shorted here. Your stop location has nothing to do with your entry. Your stop location has to do with what the market is doing at the moment. Another strong breakout, new low. This is therefore a major lower high. And if it's in a bear trend, it should not get above this high. And therefore, if you're holding short on the belief that it's in a bear trend, it's reasonable to tighten your stop, to trail your stop down to above the most recent major lower high. And you keep doing that until either the end of the session or until there's a reasonable buy signal, and then you get out. Your premise is that it's in a bear trend, and therefore it should be forming lower highs. And if it stops forming lower highs, then it's no longer in a bear trend. Is this a major lower high? We have a strong bear breakout, but only one bar did not get to a new low. Therefore, this is not a major lower high, and therefore traders should not lower their stop from here to here. And you can see this high looks like it's a little bit above that high, and most bears would hold short. If they did not get out here, they're not going to get out here. They'll rely on their stop up here. When the market's in a bear trend, it sometimes has pretty strong looking reversals. We have a bull bar here and an even better second attempt to reverse up here. However, the channel is tight, the entire trend is tight. As long as it's not going above a major lower high, this is probably going to be a bear flag or a trading range. We get a strong enough reversal up so that we'll probably get at least a small second leg up. But unless we get above this high, this is just going to be a double top bear flag. Or you can call it a triangle. We went down, we went down, we went down. You can call it a wedge. We went up, we went up, we went up, even though it's not a wedge shape. In any case, it's much more likely a bear flag that will lead to a resumption of the bear trend than a reversal. It's too small a pattern to be a major reversal, and therefore it's probably a minor reversal, which means a bear flag. If a trader exited, he would sell again here. If he did not exit, he might add to his position here, double top bear flag at the moving average. When you took this trade, if you took this, you knew you only had a 40% chance of a swing down, 60% chance that it would either go sideways or possibly resume back up. But your risk is relatively small compared to your potential reward. Most successful swing trades end up as trading ranges, sometimes after a small swing profit, sometimes after a big swing profit. This is a bear channel. A bear channel is a bull flag. 75% chance we're going to get a bull breakout, and this entire bear channel will evolve into a trading range. Maybe the top of the range will be here. The most recent really major lower high might retrace the entire trend. Here's a 60-minute chart showing what took place over the next 3 days. This brown box is this brown box. This is the 5-minute chart. This is the 60-minute chart of this same 5-minute chart. And you can see that even though it was a strong bear trend, the next day it reversed up, and it reversed up for several more days. And therefore, even though it was a successful major trend reversal down, it ended up reversing into a larger trading range. And in fact, it went above the top of the bear trend. 2 days later, it was back above this high. Therefore, when you see a major trend reversal on the 5-minute chart, don't assume that it's going to lead to a trend down for the next 5 days or 10 days. It's probably going to evolve into a trading range within a day or two. However, it's still a very good profit for a day trader looking for a swing trade down. What do you do here? We have a bull trend and then a higher high major trend reversal, but we're at the end of the trading day. It's a higher high major trend reversal. It's an okay swing trade, but one problem you have is there might not be enough time for a swing. It could just go sideways, but it's a reasonable short. You got a bull trend and a high 2 bull flag, a double bottom bull flag at the moving average, but it's late in the trend and it's near the end of the session. It might be the final bull flag. That means that if we get a new high, it could be the end of the trend, and we could get a reversal back down into the final flag and either a trading range or a sell the close finish at the end of the day. We have gap bars, although you might not be able to see it. There's a gap between the high of this bar and the moving average, and then again here. When you get moving average gap bars late in a trend, they usually lead to a major trend reversal attempt around the prior high, and therefore that's another reason to be looking to sell here. MAG, moving average gap bars. If you take this short, you really need signs of strength because you're right at the end of the day and you really don't have that much time. Most of the bears will get out, especially above a second bull bar here, first bull bar, second bull bar. They'll get out above here. And look what happened. This high went exactly to the top of that bull bar, but not above. What does that tell you? It tells you that the bears were able to prevent the market from getting above this bull bar. They know that a lot of the bears would exit there, and they know the bulls were trying to get it above there. But it got there and turned down. That's a good sign for the bears. They were able to stop the bulls from forcing the bears out, and that means we're probably going lower. And now we have a 5, 6, 7 bar bear microchannel, and it became a sell the close finish. You're at the end of the day. If the market's not going your way, you have to get out quickly. For example, we have 2 legs down, 1 pullback 2, and a bull body. Even though it has a big tail on top, most bears would get out above that bull bar because there's just not much time in the day. And if it starts to go up for a few bars, you'll run out of time before it can go back down. My general rule is if it goes 1 tick above a bull bar, I get out. If it goes 4 ticks above any bar, a small bull bar or a bear bar, I'll get out at the end of the day. And bears will take profits at the end of the day, the final seconds, the final minute or two. Very strong bull trend. A higher high major trend reversal. We broke above the bull trend, and we went up, bad follow through, and we're reversing down. We have a bear bar. It's a reasonable short looking for a swing down. You have a biclimax, the strongest bull breakout very late in a bull trend, probably an exhaustion bar. Exhaustion does not mean reversal to an opposite trend. It simply means usually a pause in the bull trend, but it can lead to a reversal, and therefore it's reasonable to short below that bear bar. Small 2-bar final flag. If you take that short, what do you do when you see this bar? You're saying, uh-oh, that's a double bottom, and it could be a double bottom bull flag. This whole thing could be a big bull flag, a pullback from this very strong small pullback bull trend, and you have an exceptionally strong buy signal bar. If you take this short, you have to get out above that bull bar because the bulls have a reasonable argument for this being a double bottom bull flag. It could not fall below the bottom of this strong reversal up. Therefore, this is a major higher low, and the bulls got down to it, but not below it, and now it's resuming up with a very strong bull bar. Sometimes you take a short, and it's reasonable to take the short, but if you get a reasonable buy signal after you take your short, you have to get out, and that's what took place here. It's hard to reverse. If you took that short, it's hard to reverse to long here, but you have to get out of the short, and if you did not take the short, it's reasonable to buy here. If you did get out of your short here, you can wait for 2 or 3 bars and then buy, maybe buy this close. Or buy above this bar, a wedge bull flag to the moving average. Down, up, down, and then a bull bar closing on its high. Most traders do not like to reverse, even really experienced traders. I've been trading for 30 years, and I don't reverse all that much. I prefer, if I took that short, I would get out here and then wait 1 or 2 bars and then look to buy if I wanted to buy. In this video, I talked about how a lot of traders don't like the initial entries for major trend reversals because the probability is usually only 40%. While a 40% probability is still good if you have a reward several times greater than your risk, some traders prefer to wait until the probability is higher. In other words, they wait for a strong breakout and then they enter. Both approaches are reasonable. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on trading major trend reversal tops.